We think we're in store for some weaker reports upcoming.
The labor market's still relatively sideways.
The signals are muddled. They're not telling you what they typically tell you because a lot is going on.
Things could change. The U.S. labor market can turn around quickly.
This week, it's all about Friday.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, it's Payrolls Friday. Economists are looking for a solid 80,000 jobs added in July as a boatload of alphabet debt is helping to keep bond yields elevated, and additional hawkish Fed officials are lining up to share their views on the Fed's next move.
Yesterday, we heard from St. Louis Fed President Alberto Musalem talking about how it's just been a really long time where the Fed has been above that 2% target, and is saying against this backdrop, it is crucial that monetary policy put a meaningful restraint on underlying inflation rather than tolerating somewhat higher inflation. In other words, seemingly lining up behind the idea of a more hawkish reaction function. I do wonder whether the market's listening, whether the market cares. It really is only the cadre of members at the core, which is the governors, that really at this point will move the dial. Nonetheless, moving toward trying to up the probabilities of September rate hike.
The committee is changing, just not in the way that was originally envisioned, perhaps by the incoming Fed chair. The weight of the Fed is becoming more evenly distributed across the individual voting members and beyond the voting 12. That's the problem that the Fed chair's got right now. He wants to go in one direction, reduce the communication, reduce the dependence on the institution. Everyone else is still heading in a different direction.
Yeah, although you aren't necessarily seeing the odds of a September rate hike rise to where they were before the press conference. This is what's notable. There still is a great degree of ambiguity baked into this market, with almost a coin flip being baked in to September. So here is the issue that I have with today's data. How much does the labor market data matter? How much is this entirely the CPI print? And if you get above a certain metric, suddenly you have officials lining up saying, this is my tolerance for impatience, and we're there.
The labor market data today doesn't really matter. Potentially, it can help the Fed in terms of directing policy towards September. But we already heard basically from Kevin Warsh yesterday, through people familiar with the matter, talking to the Financial Times, that he's looking at CPI. And if inflation readings released in coming weeks are hot, according to the Financial Times, and markets ratchet up their expectations for borrowing costs to go higher, then potentially that's when we can get this hike.
I'm pumped about payrolls.
I am too.
8:30 Eastern Time. Start the show, Bramo.
I think
First
it's
couple of
really
minutes.
important.
Come on. 8:30, nothing else matters.
I mean, to me, this actually is the key question, because we're looking at the actual economy and what the different dynamics are underpinning it, not just whether the Fed will hike or not.
80,000 is the median estimate in our survey. The range still pretty wide, 157 at the high end, at the low end, 40K. Let's move on and talk about the supply monster. Love talking about the supply monster. The supply monster right now is Alphabet. Alphabet issuing another $25 billion worth of debt. It follows $50 billion plus through the first half of the year, on top of an $85 billion equity capital raise earlier this year. That is a lot of money that a single company is borrowing at the moment.
Yeah, Alphabet is the leader among all of the hyperscalers and other tech companies in terms of total debt and equity raised so far this year. Interesting to see that this was a well oversubscribed deal. Yes, they all are well oversubscribed. It's a question of how much you have to pay to get that oversubscription, and it does seem like they did have to pay a premium. Nonetheless, still plenty of demand. And here is the ultimate crux of the issue, and Vishy Tirupattur of Morgan Stanley is coming on later this hour. There is so much debt that still needs to be financed. We're not even halfway through. Question is, what will it cost to get there, and who is not going to be able to afford it along the way? Not necessarily whether the market's going to completely close.
Yields elevated across the curve. Check out 2s, 10s and 30s this morning. 2s down about 2 basis points, pushing higher through yesterday's session. On 10s this morning, we're down to back to about 466, but still very close to 470. If you're at the Treasury right now, you're contending with a lot. Not just the issues, the perceived issues at the Federal Reserve, but also the situation in Japan, the situation with Alphabet. That's just keeping yields at the long end slightly higher than they otherwise would be.
Yeah, absolutely. And the fact of the matter is, potentially we're going to have to see another yen intervention, given what's going on with dollar yen, and this concern from the Treasury market and from the Treasury Secretary that potentially are they going to have to at some point maybe dump treasuries in order to defend the Japanese yen.
We're going to have that conversation in just a moment. We'll catch up with Chris Verrone of Baird Strategas as equities and bond yields rise. We'll speak to the former senior US intelligence official, Roule, as Iran moves to block US ships through the Strait of Hormuz, and Oscar Munoz of TD Securities predicting a softer July payrolls report. We begin this hour with stocks pairing modest losses, holding their all-time highs. Chris Verrone of Baird Strategas writing, with the S&P 500 rallying with such potency, there's also likely some value in identifying what is not exhibiting similar vigour. Chris joins us now for more. Chris, good morning. Good to see you.
Great to be here.
What is not exhibiting similar vigour?
Well, I would say on balance, this has been a very good rally, certainly the last week. But just go back the last 6, 7, 8 weeks, they threw everything they could at this market, whether it was bond yields, whether it was oil, whether it was the war. And the best they could do was maybe a 2 or 3% drawdown in the S&P. Extremely rotational tape. You know, we've been observing for weeks and weeks that the internals have been getting better, not worse here. Now, there are some pockets of maybe the market that are a little bit squirmy here. The utilities, as an example, I think there's a political crosswind that started to impact a number of those names, particularly on the power producer side, the CEGs and the Talons and the Vistras. But I'd say on balance, you know, 75% of the S&P is above the 200-day right now. That's about as broad as we've seen in 2 or plus years.
Is this bond market close to becoming a problem? Speaking of squirmy,
you know, it's funny.
The yield curve in the last week. Go on, give me your thoughts.
I'm going to tell you something that I think might surprise you here. We're 400 days since Trump 2.0 started in January of 25. That 400-day period, the range of the 10-year yield, 85 basis points. It's the lowest 400-day range in history. Go back as long as you want. Bond vol is very, very muted right here, right? I think when you look at what the reaction function from Treasury or from the administration has been, I think the goal is to limit bond vol, preserve optionality. And when you look at one of the tightest 400-day ranges in history, I think that certainly speaks to that.
Wouldn't you think, though, that less communication would introduce more vol?
So you'd think so, but the market response has been entirely different thus far. I mean, even from the Fed last week, 2-year yields are lower, not higher. 30-year yield is flat. Double B corporate spreads, you know, talking about Alphabet going to the bond market, why wouldn't you? Double B corporate spreads are on the tights right now. So I think the things that we look at to kind of gauge the health of the economy, the bond market, and the equity market are still pretty much in check. I mean, every bank stock around the world is at new highs right now. Credit conditions everywhere are about as benign as it gets. I'm not saying those things can't change, but if you're looking at the landscape today and trying to evaluate in the present moment, are conditions still supportive? I think they are.
Well, I think that the equity market is telling you that, with the fastest kind of whipsaw back to oversold that we've seen in modern history, or one of the fastest reversals. Bank of America's index says that we're now the most oversold or over bullish in terms of sentiment going back to 2021. Is that a sell indicator to you, the same way that it is to Michael Hartnett?
I think you need bulls for bull markets. So I'm not as convinced that, you know, when you look at, and, you know, we've dived into this for years and years and years, sentiment at tops is not very helpful. It's very helpful at lows, right? Fear and panic is a much more actionable emotion than the greed that's often found at top. So, listen, we're very mindful that you know, as this market has made new highs, you have certainly, I think, seen the attitudes get a little bit spicier here. I would yet to say that we're in that, you know, everyone is completely all in. There's no buyers left. I don't think we're at that point yet.
When you look at that narrow range on the 10-year and you say that you know the reactionary function from the administration, is that the reactionary function that this bond market for this administration still remains the key? It's the biggest check on Trump and the Treasury.
You know, I think it's interesting, Annmarie, because you brought up Japan and yen, which I think certainly playing a role in some of this. You know, go back, look at the last 2.5, 3 years on the yen chart. I mean, it's every time you're in this 160, 162, and I know we pushed 165 a couple weeks ago, where you get kind of either BOJ or Treasury a little agitated here. And I think the actions of the last week or so certainly reflect that. But I would just make an observation. I think all these calls out there that higher JGB yields are about to blow the world up are so hyperbole and so misleading.
What are people getting wrong?
I think people are getting wrong that we're in a reflationary boom in Japan for the first time in 30 or 40 years. And
so
yields
why is
should
everyone
be up.
so freaked out by what's happening?
I think it drifts with yields in Japan higher. I think it raises the floor on yields around the world. So I understand the agita there. But as far as Japan, Japanese bank stocks trade great, Japanese insured stocks trade great. So if there was something truly systemic about higher JGB yields, I think it'd be showing up in those avenues. It hasn't.
This sounds like more like a counselling session for the Japanese officials and Scott Bessent than it does people on Wall Street, because the concern that I've seen at the moment over the last month or so stems from the Treasury and stems from Japanese authorities. I haven't actually heard too many people around this table freak out about the situation in Japan.
You know, I think what's pretty remarkable, and we said it off air, is Japanese 10s are about to cross German 10s for the first time in a very, very long period of time. I mean, which economy is in better condition right here? I would argue what's happening in Japan is a massive departure and change from what we've seen from that economy in 30 years.
Part of the problem is that you can talk to the 10-year and how range-bound it's been. The 30-year has not been range-bound. And this reflationary boom is happening in the backdrop of massive capital raise. We talked about Alphabet and the $25 billion of bond sales. I just wonder, how much does that constrain some of what the Fed and Treasury can do? Speaking to what John was saying, the concern about the reflationary boom that they're seeing in Japan.
So nominal GDP is what, 6.5? Where should 30-year yields be with 6.5 nominal? I think you could make a very valid case that, 520 is by no means extraordinary. You kind of go back and you look at the kind of great decade of the 1990s. There wasn't a day in the 1990s where the 10-year yield was under 5%, right? So I just think we have to put this in a little bit of context. I've always been of the view, when you look at these kind of bubble-like equity environments or melt-up-like environments, they tend to end with both equities going parabolic and bond yields going parabolic. I think 87 it happened. In 89 in Japan it happened. You had the Nikkei double that year. JGB yields went from 4 to 8. In 99 it happened. The NASDAQ clearly did what it did. But people forget, U.S. 10-year yields in 99 went from 4 to 7. So that's how these typically end. I don't think we're in that explosive bond environment just yet.
Debt to GDP ratios have changed.
Yeah, fair.
We're running persistent 6% budget deficits even in good times. That's problematic. Clearly, the Treasury is very uncomfortable about allowing people to monetize their dollar reserves at the moment based on the access the Japanese have been given to a particular vehicle over the Federal Reserve. That would speak
Although
to
not
unease.
used. I believe it hasn't been used.
Hasn't been used.
FT reports this morning has not been used.
But it speaks to unease of the Treasury. And some people might say for good reason that these yields are getting away from them at the wrong time when the backdrop for fixed income right now has changed. There are problems in Germany, there are problems in Japan that we didn't have to otherwise confront. And you know where I'm going with this? Because 15 years ago, when we would all sit around this table and people would complain about the deficit and, the supply concerns, and a lot of those concerns were misplaced, but the backdrop for fixed income was so different. We had an anchor in Japan, we had an anchor in Germany, and the biggest companies in this country weren't issuing debt in quite the same way. There's competition for capital in a way that did not exist 10, 15 years ago. We have to confront that. The Treasury does too. And there's obviously a reluctance for them to term out the debt as well. So you say this is normal. I don't think the Treasury thinks this is normal at all, which is why they won't extend duration at all. And they keep guiding the Treasury market to expect the same kind of issuance because they're nervous about what's happening with long-end rates.
Well, if you look historically, the issuance on the short end is still running below the long-term average. And this is, it's really no different than how the Yellen Treasury funded the government here as well. I think what's interesting, and we use the term, we're entering the alpha market, right? This is a market where I think ambiguity is greater than people are used to. I think it's an environment where there's no free lunch. You have to pick stocks. This is no longer the kind of 15 years of QE and forward guidance that everyone gets trophies. So I think it's an important shift, and one will have to adjust. There are so many moving pieces here at the moment. In this 10-minute discussion, right? We've talked about Treasury yields, we've talked about yen, we've talked about equities. I think you've really got to stay on your toes here. And I kind of liken this from the transition from the 50s into the 60s, where you had a very docile decade in the 50s. Bond yields got to about 5.5 or 6 in the early part of the 60s. You bounced around for the next 6, 7, 8 years. It was a decent decade for stocks, but you had multiple corrections, multiple bear markets, multiple economic cycles. I think that's the environment we're in. Think about the equity market this year. It's been all E, not PE, right? PEs are down, E's up a lot. That's inherently a more cyclical economy. I think it's one that we ought to get used to.
Chris, appreciate it.
Always great to hear, yeah.
And right so far. Chris Verrone there of Baird Strategas. Thank you, sir. Let's give you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. Concerns of a widening Middle East conflict growing. The Houthis reportedly attacking Saudi-backed government forces in Yemen and a southwestern region in Saudi Arabia. The Iranian-backed militant group claiming drone and missile attacks killed and injured hundreds of troops in Yemen. Chip giant SK Hynix is planning $38 billion in spending to double production capacity in South Korea. The company saying in a statement that construction on 2 new plants is in response to continuously growing demand for memory in the AI era. The US and Japan's historic currency intervention coming to the surprise of key allies. The Financial Times reporting policymakers in Europe were blindsided by the arrangement, with the US not informing the ECB that it sold euros to buy the yen until after the transaction. And that is your Bloomberg Brief. John.
Vonnie, thank you. Appreciate the update. Up next on the programme, a diplomatic deadlock in the Strait of Hormuz.
It's sort of open right now. You know, we have a thing called the blockade headed up by the U.S. Navy, and we control it. I think it's going to end pretty soon. I don't think they can go much longer.
Up next, we'll catch up with the former senior U.S. intelligence official, Norman Roule, live from New York City this morning. Good morning. Payrolls at 8:30 Eastern Time. We're looking for ADK, and then it's on to CPI a week away. CPI on August 12th. September 4th, another payrolls report. September 11th, another CPI report. And then on the 16th, a Federal Reserve meeting in the middle of September. That's the runway. That's the path to the Fed's next decision. Equity futures this morning on the S&P positive by about a tenth. On the S&P 500, on the Nasdaq positive by 0.4. Under surveillance this morning, a diplomatic deadlock in the Strait of Hormuz.
It's sort of open right now. You know, we have a thing called the blockade headed up by the U.S. Navy, and we control it. I think we're doing very well. I'm involved in the negotiation. I think it's going to end pretty soon. I don't think they can go much longer.
So here's the latest this morning. The president claiming to have control of the Strait of Hormuz as Iran seeks to block U.S. and Israeli ships from transiting the critical waterway.
And there was also apparently some attacks as well at the opening of the Strait of Hormuz yesterday, which is why you saw oil prices move higher. The fact of the matter is, the president said yesterday it is sort of somewhat open. It sounds very much like concepts of a plan. They have an idea of how they can get traffic back through. But the fact of the matter is, if Iran is not going to allow U.S. or Israeli ships, what insurer is going to allow other ships even to want to transit through the Strait of Hormuz? Very messy situation.
To build on that, the former senior U.S. intelligence official Norman Roule writes the following. The U.S.-Iran conflict now has many fronts where violence is intermittent but could flare up with strategic consequences. Norman joins us now for more. Norman, welcome back to the programme, sir. How would you characterise this particular agreement? Would you even call it an agreement?
Good morning. Well, we certainly have a greater possibility of a diplomatic agreement now than at any time in recent weeks, but the maximalist demands of Tehran and its use of intermittent regional violence is making the conclusion of the agreement unpredictable. Likewise, we should note that just execution of this agreement will require Treasury to issue rules as to how firms could pay if fees are paid. And if fees are not paid, then we have to prepare for additional violence by Iran in the future. Iranian decision-making is not unified on the need for concessions. And indeed, there is no sign of a pro-concession party in Iran at this point.
Norm, how can Treasury green light these fees if Iran is not allowing U.S. vessels to transit?
That's an excellent point. And we should keep in mind it's U.S., Israeli, could be U.S. or Israeli related. The definition of that concept could be quite significant. And in essence, what Iran is doing is not only keeping the U.S. out, but dictating to Gulf states who can deliver their food, their energy, their trade partners, this would have a significant impact on global commerce, so it can't be conducted. We can't rule out that this is just a negotiating threat by the Iranian parliament. It doesn't have decision-making authority, but there have been examples of Iranian parliament making decisions, such as 60% enrichment, that have been executed by the government when approved by the Supreme Leader and the National Security Council.
Norm, there have been some Gulf countries that have been able to get oil and other products out, namely the UAE. How have they been able to do this?
Most of the Gulf countries that use the Strait of Hormuz have exported oil in recent weeks. They've done it quietly through the Oman Channel in close coordination with the U.S. military and obviously the government of Oman. But Iran has intermittently used its degraded missile and drone capability to demonstrate that it has a capacity to strike some of this shipping. And that capacity has the greatest impact on LNG, which has essentially been shut down in the Gulf.
Norm, we've heard about a toll being unacceptable, not only to the U.S., but other Gulf countries that are neighboring Iran. Is a service fee acceptable? A 5 to 7% service fee is currently being proposed by Iran.
Certainly not. You can call it whatever you wish, but it's a shakedown. And that fee can be changed. Now, Iran is entitled to compensation or to charge if it were to take care of a pollution issue, a security issue, rescue a ship in danger. That's not unreasonable that any country would ask for that. But Iran is providing no services. And to be clear, the last time anyone charged a fee in the Strait of Hormuz was April 1622, and that was the Portuguese.
How do you see this evolving, given the fact that it seems like President Trump has some reluctance to engaging in kinetic warfare again? There's been a discourse about whether that's tied to the munition stockpiles, questions around whether anything additional can be accomplished with airstrikes that hasn't already been accomplished. What do you see as a potential path of travel should these negotiations not yield anything?
Time, tenacity by the diplomats and the intermediaries. The United States is certainly pursuing a diplomatic route along with the Gulf parties, but events may shape that into a different direction. The Houthi attack on Saudi Arabia, we'll have to see if the Saudis follow through with retaliation. The reported attack that took place yesterday on shipping, and will the U.S. retaliate? If we don't, Iran will continue these attacks, and it's not assured that diplomacy will succeed. But at the same time, the diplomatic path forward will require concessions from Iran. If that doesn't occur, we're in a new normal.
Where has the U.S. set deterrence then? Because the IRGC is still going after vessels through the Strait of Hormuz, and at the same time, the Houthis are now involved.
Well, that is true, but the nature of the attacks are limited. They're infrequent. They're usually singular. They're not involving saturation strikes. There is no question that Iran's military capacity has been significantly degraded, but degraded does not mean eliminated, and that's really the question.
Norman, we always appreciate your time, sir. Thanks for sharing it with us this morning. The former senior U.S. intelligence official, Norman Roule. Based on what we've seen develop in the last week, we've seen little evidence that we've managed to break out of what we've called on this programme many times, that uncomfortable status quo, that uncomfortable new normal since the end of February.
Yeah, we're going to be living in this purgatory because even if we were to see potentially a resumption of ships being able to pass through the Strait of Hormuz, there's no evidence yet that the IRGC, maybe they're discussing this in Parliament, but that the IRGC is not going to use asymmetric warfare and go after a boat or two. And the second one vessel gets attacked, they might as well all have been attacked because that is when the transit stops.
Chris Verrone was talking about the range on treasuries throughout this administration. I think he said something like 85 basis points. I'm fairly certain that the low and the high of the administration has come in the last 5 months. And that range has been dominated to some extent by developments around this story. The low on yields was in the immediate aftermath, just around the invasion. And then it was up and away, and we never really looked back on 10-year treasuries. We never really erased that decline. And I think that speaks to the concern on this issue against a pretty unforgiving backdrop around the bond market too.
It speaks to the impatience by Fed officials after more than 5 years of above 2% inflation, but it also speaks to supply shock after supply shock. And if you have supply shock after supply shock in an otherwise robust economy, those supply side inflationary drivers can take on a life of their own. And that is the fear, even though typically central bankers look through this.
People have said this countless times, but how exhausting has that story been?
I mean,
crazy.
I get messages about it every day. Really? You're still doing this?
Deal. What?
Okay, I know, you're preaching to the choir. The issue is, this is a story and it does continue.
Up next, Vishy Tirupattur of Morgan Stanley as demand for Alphabet's AI debt outpaces some expectations. Futures positive this morning, up by 0.2% on the S&P. On the Nasdaq 100 so far, we're positive by 0.4. 2 days of very muted losses on the benchmark stateside, pulling back from all-time highs, but still on track for a second consecutive week of gains on the S&P, heading towards the best weekly gain since April. That's the stock market story. Let's get you some single names. Your morning movers with Yahara. Hey, Yahara.
Hi, John. We start with Cloudflare. Shares are rising at nearly 16% in the pre-market after the cybersecurity company delivered a beat and a raise. Remember, this was one of the first companies alongside the fintech block to make a big bet on AI replacing some internal work. So it cut about 20% of its workforce earlier this year. Initially, investors had questioned whether that would hurt growth, but these results appear that it hasn't. I will also say the bar was pretty high, with shares up 45% heading into the results. Meanwhile, in another sign that travel demand remains healthy, Airbnb raising its full-year outlook for the second time this year after another strong quarter. So we are seeing shares up 7.5%. That was due to strong demand in the U.S. and in Europe, but it also says that it got a boost from first-time users staying in Airbnbs during the World Cup. It echoes what we heard from Booking Holdings at Expedia, which also had good results earlier this week. And we end on a big mover to the downside. Sweetgreen down more than 15% in the pre-market after it's cut its outlook, saying that recent food safety concerns are keeping customers away from its restaurants. The company had already been grappling with traffic decline, so it had been trying to revive that by introducing cheaper menu items. But this latest outbreak affecting lettuce and now apparently a recall affecting jalapenos is really complicating this turnaround story. John.
Yahara, thank you. Not going to lie, quit salad.
Because of sleepless paralysis?
I did.
Really? Well, so did everybody else. Salad and go file for bankruptcy.
For the last couple of weeks, yeah.
Really? But it's just, hold on a second.
It's getting difficult, Bremer.
Okay, first of all, it's just the iceberg lettuce. If you have lettuce that actually has nutritional value, you're fine.
Yeah, so you want to do that at home. Why would I go trust other people to follow those rules?
Precisely.
So at home, I'm eating salad.
Yeah, honestly,
out and about, I am not eating
I've got no leg to stand on. I never
Not as trustworthy as I once was,
but
Bremo,
really?
About the food supply.
You really?
Are you okay?
Okay.
Hold on a second.
When was the last time you ate at Sweetgreen, Lisa?
I plead the fifth.
Exactly. She's doing the same thing we are.
Of course she is. Come on.
Anyway.
On a radar this morning, Iran aiming to prohibit American-Israeli ships from the Strait of Hormuz in its latest demands for a peace deal. Tehran also pushing for compensation from hostile countries before granting them access to the waterway. Elsewhere, US and Japanese intervention into the currency market coming as a major surprise to the Europeans. The Financial Times reporting the US waited until after it sold euros to buy the yen to inform counterparts in Frankfurt. And finally, the president renewing his support for Fed Chair Kevin Warsh.
It's up to him a little bit, but not completely. He's got a board that's very political. The United States should pay the lowest interest rate in the entire world. I think he's great. I won't be criticizing him.
The Fed chair's communication style dividing Wall Street and Washington. Uncertainty adding to bets the Fed will hike rates at least once before the midterm elections.
Yeah, and potentially putting the emphasis on other Fed officials who have been speaking and had a more hawkish tone over the past couple of days. Key questions here. Number one, a lot of people who have talked with Kevin Warsh and have had communications with his camp recently sort of reiterate that he is independent, et cetera. There is a feeling right now that potentially there could be a more hawkish shift, but he's in a very tenuous spot because of the pressure coming from the president, whether it's directly at him or not. The other question I have is, what is the benchmark to hike rates, right? What is the definition of impatience after more than 5 years? What is exactly the threshold going to be?
Well, for the president, we've heard this before. He has now really backed off on criticizing the Fed chair directly, and he's going after, he said this line a ton of times, that it's a very political board, which is interesting because some of those individuals that are on the board were actually appointed by this president in his first term. I also think it's a little interesting. I learned a new word through this entire interview. The president said the Fed is now bekokkt, which means extremely messed up or poorly managed.
Or something else, which we won't talk about.
Or something else if you look at Urban Dictionary. But he thinks he wants to go back to this old world, and he continuously talks about this, where good news comes out and people aren't immediately selling off in the stock markets because they think the Fed is going to hike interest rates.
The issue that I think the president has, and I'm sure that countless people have tried to explain it, from what I understand and what I see and what I hear from him every time he talks about the issue, he appears to confuse credit with developed market sovereign debt, and the way that credit responds to good news and the way that developed market sovereign debt responds to so-called good news. If you are a creditor, if you're issuing credit and your balance sheet is getting stronger, not worse, you should receive a lower interest rate. That makes sense, right? But if you are the Treasury market, say, and the data gets better, I'm going to put money elsewhere, right? If inflation risk starts to build a little bit more, I'll move out into risk assets. That tends to be how it works. In Treasury markets, of course, when the data's really bad, Treasuries rally because people flock to the safety of Treasuries. I mean, that's sort of like 101 of the bond market, credit versus developed market sovereign debt.
Yeah, I feel like the bond market and markets in general kind of treat President Trump's comments on the bond market like they do a grandfather who's telling them something that they know
that
isn't accurate.
Was for anyone who accidentally tuned into Bloomberg this morning.
And they're like, oh, that's nice, that you think that, but it doesn't really affect my life, and I know that you're wrong. At the same time, I think that there is a feeling, what is his influence over actual policy in Kevin Warsh? And that, I think, is the ultimate debate that a lot of people are trying to parse through.
What is Warsh's influence over this bond market right now, given the issuance we just saw in the last 24 hours? Alphabet, of course, reigniting investor appetite for hyperscaler tech debt. The Google parent company receiving roughly $115 billion of orders for its latest mega bond sale, more than 4 times the expected deal size. Vishy Tirupattur of Morgan Stanley writing, surging supply has been balanced by robust demand, keeping market-wide spreads anchored even as AI-related debt underperforms. Vishy joins us now for more. Vishy, good morning.
Good morning.
Let's just start with the supply, just the raw numbers here. The amount of money that is being raised, the amount of debt that is being issued. Just walk us through that and how much more you're expecting of it.
We are expecting a lot more of this to come through across the credit ecosystem. So we look at the total capex needs of the AI ecosystem, and we put that number between 2026 and 2028 at $3.2 trillion. And that needs to be financed through equity and credit channels. We think credit is going to be $1.75 trillion of that $3.2 trillion is what we pencil as the credit mechanism. And when I say credit, I just don't mean public investment-grade credit. I mean investment-grade credit, high-yield credit, leveraged loans, public, private, structured, securitized, all of the above. So we expect this to, this issuance and the behavior is not going to be uniform across all these pockets. Some are insensitive to the level of rates and level of spreads in a broad range. Some parts of this ecosystem very sensitive to the ultimate level of yields. So there's the multiple things going on here.
Well, let's talk about what's changed in the last 5 months or so. Since I would say SpaceX, when they IPO'd and then subsequently offered some debt, there was some pushback. The demand was, let's say, below expectations and below average for what we've seen through most of this year. Then Amazon came out and they had to offer more concessions. I believe that Alphabet had to do the same thing in the last 24 hours. These aren't major moves, but they're incremental and heading in one direction. How much more of that do you expect to see for the names that are coming to the market, 1? And 2, do you expect it to influence borrowing costs for other companies outside of tech issuing into this market?
So the first one, we do expect this, what we call high-quality hyperscalers, the Microsoft, Meta, Google, Amazon, who average trade quality is about AA. And we expect that they are less sensitive to the level of rates or level of spreads. And they have tremendous amount of needs for CapEx. And we expect the market is open to them. And we expect that to continue to be there. Wider spreads are the pressure release valve. So we expect spreads on those things, to those names or the high quality hyperscaler debt to continue to widen. And where we think is that it will eventually drag the non-IG debt, non-AI related debt also to widen somewhat. So far, non-AI debt hasn't moved much at all. We expect that to change a little bit. We expect that we are, in the cash index, we are high 70s-ish, about around 80 basis points of spread. We expect that to be in the 90s by in the next 6 to 12 months.
There's a sort of belief right now that a lot of these AI-related companies are rate insensitive when it comes to their borrowing plans. Is that true?
It is true for some of them. It's not true for all of them. It is rates insensitive. I wouldn't say rates insensitive. In a certain range, in a fairly broad range, the very high-quality hyperscalers are insensitive to the level of yield they have to pay out.
Up to what, like 9%?
Up to, for example, the 10-year Treasury in 350, 455, probably not that different, right? If you think in those terms. But if you go down in the ratings category, go below the high yield names, there is a level at which it's not economical for them to keep issuing. So we expect issuance to continue, but bulk of that issuance from the higher quality names as opposed to the lower end names.
I've heard from a number of investors that increasingly investment grade looks like it potentially has more risk than high yield. And this is coming at a time of mass issuance, of an increasing proportion of the overall index coming from technology, and frankly, really long durations. You also have the duration risk. Do you think that right now, investment grade bonds are riskier than high yield given this backdrop?
I wouldn't say riskier. I think I look at the prospect, we can measure risk in many different ways. If you look, are they riskier from a sort of a default probability perspective? They are not. They are not riskier than high yield. On the other hand, if you look at the direction of travel for spreads and perhaps ratings, there is a greater potential for some of the higher quality names to take one or two rating notches downwards. Whereas within the high yield spectrum, there are the Bitcoin miners, the neoclouds. It's a large ecosystem. Those Bitcoin project finance type of bonds that are coming in the high yield space, there is once the construction stuff is done and who are the leasing the facilities is in place, there is a possibility for an upgrade. So that's the differentiation here. And the high yield, this part of this, the avalanche of supply is really investment grade focused. It's not in the high yield focus. So technicals are in favor, and there's a potential for upgrades. So that means that the prospects are better for we like high yield portion of the AI related bonds more than we do high grade.
Vishy, can we finish on rate sensitivity? There is a massive difference, of course, between being rate insensitive and not being very rate sensitive. At some point, everyone's got a price where they have to defend their rating, and they start to respond to the pushback. Where do you believe that level is?
So I think the rating itself, some of these companies, as I said, the four firms I named, average grade quality is about AA, and some of them are trading closer to single A names. So the market is already treating them lower, and their business models are perfectly intact, even if they're one or two rating notches lower.
Right.
So they're, if you're a AAA company and U.S. Treasury is AA, so therefore, that there's some scope for.
Thinking more of the oracles of this world.
Right. Oracle is a very different story. Oracle is a very different story. We have been short Oracle debt for some time, and Oracle is in a very tough spot. The amount of their ability to issue debt is very different. And so I want to distinguish between the high quality hyperscalers versus the oracles of the world. That flexibility that exists for the high quality hyperscalers does not exist for the oracles of the world.
Are we close to a reckoning for those companies where they have to change strategy?
They are, we got in a downgrade in Oracle. Oracle, S&P downgraded them to BBB minus, which is the cusp of below investment grade.
And that debt is trading like junk already, right?
Right. So that is definitely a challenge. If you go below that, it's a very challenging situation for Oracle.
Vishy, appreciate it. Thank you, sir. Vishy Tirupattur there of Morgan Stanley, really framing what's happening right now in corporate credit. Some issuers have got some privileges that others don't.
What's fascinating to me is we still have $1 trillion to go. This is just the beginning, right?
That's a lot
so we
of money.
keep talking about that, and you start wondering, okay, well, how big is that concession, and sort of who are the casualties along the way?
It's getting bigger. Let's put it that way. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. SpaceX shares rose on Thursday after the release of more than 900 million shares worth about $100 billion from lockup agreements. The stock closed up more than 6% after fluctuating between gains and losses in early trading, with more than 255 million shares changing hands. Meta to pay $942 million after a major child safety ruling. A New Mexico judge is ordering the Facebook and Instagram parent company to pay penalties, set aside money to address youth social harm, and limit how long underage users in the states spend on its apps. Details are emerging on OpenAI's upcoming consumer device. Sources telling us here at Bloomberg the device, which will function like a smart speaker without a display, will come in the shape of a donut and likely cost more than $300. It'll be OpenAI's first piece of consumer hardware and is expected to hit the market next year. And that's your Bloomberg Brief. John.
Bonnie, thank you. Thank you very much. Up next on the programme, balancing the Fed's dual mandate.
The labour market stabilised with solid payroll growth and an unemployment rate close to its long-run value. However, inflation is well above the FOMC's 2% target.
There's another one. Oscar Munoz of TD Securities joins us next. Live from New York City, welcome to the program. Equity futures right now in the S&P firmer by a little more than 0.1%, on the Nasdaq up by 0.4. This from Michael Harner over at Bank of America. We remain in the summer retreat, rotate, not reload camp. We recommend investors retreat from risk assets and/or rotate into some defensive duration and the US dollar.
Yeah, he was talking about the sell signal and how people are getting so bullish and so extremely positive on equities. It's one of the most extreme readings since 2021, which gives him some pause. You know, the scale of the move that we've seen since the brief out leverage that we saw with respect to situational awareness.
It was massive.
Gives you a sense of just how many people were lined up for an entry point. You just wonder, how much can a market go down when there still is that kind of momentum in the market?
Have we really cleared the decks of all that leverage that was built up since late February into late March? That move we saw in chips was just a monster move. Let's turn to the bond market. 2s, 10s and 30s. Yields declined this morning, actually down on the week. 2s, 10s and 30s. Up in the last 24 hours. And up in the last 24 hours for a range of reasons, including Alphabet, with a boatload of debt in the last 24 hours. Plus, a lot of questions about the Fed's next move and where Kevin Walsh stands on a few things.
I think it's actually a really important question to ask. How much is the move at the long end because of the Fed conference last week? Certainly there was a correlation with that. And how much is really just simply the supply? If we think about the investment grade bond universe having spreads that widen out, well, think about the competition for capital and what that does to the long end of the Treasury. Alphabet just sort of gave an example, throwed a little lob of $25 billion to give a little demonstration of why this is such a significant issue.
The Fed, I would say, took a back seat to the move in the last 24 hours. I'm more inclined to say the move you're starting to see at the longer end of the curve is becoming more and more influenced by how much debt is being issued by the likes of Alphabet.
The likes of Alphabet, the likes of Japan, the likes of Germany.
Yep.
I mean, at a certain point, can you disentangle sovereign and corporate debt in a real material way if a lot of the buyers end up being some of the same?
If I was going to write a book about being bearish bonds, it would be called Anchors Away.
Ooh.
All of the bullish anchors for bonds, they're gone. They're gone. Everything we talked about over the previous 2 decades, gone.
Anchors away in bookstores.
Does that,
in
does
2
that work
years.
for you? Do you remember the yoga
From
book
Penguin.
that I never wrote? Do you remember that one?
Yeah, I do. But this was going to come out.
TK got everyone thinking I was writing a book about yoga. Unreal. Under surveillance this morning, balancing the Fed's dual mandate.
The U.S. economy has been resilient in recent months. The labor market stabilized with solid payroll growth and an unemployment rate close to its long-run value. However, inflation is well above the FOMC's 2% target, and the balance of risk is tilted towards inflation remaining above target.
I'm sure Alberto's got tons of character and charisma, but when they read these things, it's deadly,
It's
isn't it?
almost funny you say that after listening
It's pretty
to him.
deadly.
Yeah. Well, I
You know,
think that-
after you hear that, you're like, maybe Kev's got a point.
Well,
like, we should do less of this.
maybe. You're right. I mean, at the same time, people took a pretty loud message from that.
Payrolls a little bit later on this morning, 8:30 Eastern Time. This is Oscar Munoz's point over at TD Securities, looking for a below consensus 70,000, writing a stable labour market will keep the Fed's focus on inflation. An upside surprise could add fuel to the fire for hikes. Oscar joins us now for more. Oscar, welcome to the programme. Feels like the labour market's taken a back seat to the inflation data more recently. What are you looking for at 8:30?
Yeah, thank you, Jonathan, for the invitation. Right, we're below consensus, 70,000 gain for payrolls, as you mentioned. I think more of the same, very similar to what we saw in June. I think the idea, the message is that the labor market is close to where it should be, close to its steady state. I think the first half of the year, you saw strong gains in payrolls. So this is by no means, if we're right, we got the 70K on payrolls and 4.2% unemployment rate on the household survey. I think it just tells you kind of the same. The labor market is in a good place, and it's in a place that is not inflationary.
What is sort of the measure that you're looking at in the labor market report that potentially translates into the Fed's reaction function? Because right now it seems like, as John was saying, it really is squarely on the inflation data. I
completely agree. I think I think you can never downplay the jobs report, no matter what what state we are. But again, yeah, I mean the Fed has made it very clear that what they're watching very closely is the evolution of inflation, particularly over the next few months. They do want to see relief on a month-to-month basis, particularly core PCE inflation. Anything close to 0.2%, I think, would be good news for them. But the labor market, is also important for me. What I'll be looking at very closely is the unemployment rate. We've seen it dropping a little bit. I think the range between 4.2, 4.4% is the sweet spot. If you start seeing the unemployment rate dropping to 4%, I think that would be concerning for the Fed, particularly for the hawks, is in a world where inflation remains above target, kind of stuck close to 3%. If you see an acceleration in the labor market, I think that will be very welcome by Fed officials at this juncture.
How do you view some of the tertiary or secondary data points that we get? Yesterday, we got a measure of productivity that actually rose substantially above expectations, and unit labor costs actually came in substantially below expectations. And some people were saying, this is a productivity boom. This is the disinflationary growth that we've been looking for. How do you view that kind of data in light of trying to come up with a narrative or a trajectory for inflation?
I mean, you have to take it in strides. I think, productivity growth being strong has been a feature of the economy post-pandemic. I have an issue with people saying that's because of AI. I think it's very early to say that. You're not seeing that translated into TFP, in total factor productivity. So it tells you there's something else driving it, probably capital deepening. So to the extent that some Fed officials are thinking that the supply side of the economy is going to save us from inflation, I think that's a story for in 2 or 3 years. I don't think it's a story for now. That's why we have heard from Fed officials sitting in the center, particularly Governor Waller, President Williams. They're not waiting to see whether the supply side is going to improve here. They want to see disinflation, or at least progress on month-to-month inflation already. That's why the bar has been lower. If you see a core PCE print on a monthly basis at close to 0.3%, one or two of those, I think that will be enough for a number of Fed officials who are sitting on the sidelines to start supporting rate hikes as early as in September.
Oscar, good to see you. Important final note there. Oscar Munoz there of TD Securities. That final note on waiting for productivity to bail us out, that was essentially the pushback from the St. Louis Fed president in that speech.
Yeah, Alberto Muslim saying, look, we're not seeing enough of it yet. And to sort of say that this is going to come back and rescue us isn't going to fly. Again, it goes back to what does Fed Chair Kevin Warsh think about productivity? We've heard a similar tone from other people. Unclear, and I'm thinking of Neil Kashkari in particular, unclear whether productivity is increasing at the pace that AI is boosting inflation. Ultimately, that's going to be a debate that's going to be on the big topics in Jackson Hole. And I really think I'm actually really curious.
Here we go. You're super excited.
I think it's going to be interesting to see how they frame it. The blank
page.
Thoughts.
Hey.
I am excited to see what fills that page.
Grandma's vacation to Wyoming.
Not my vacation. It is a thought exercise.
I've never been. How many days you taking off after the Jackson Hole Symposium?
John. Whatever.
Priya Misra of JPMorgan joins us next. The Port of LA Executive Director Gene Seroka joins us too, plus Claudia Sahm of New Century Advisors.
We think we're in store for some weaker reports upcoming.
The labor market's still relatively sideways.
The signals are muddled. They're not telling you what they typically tell you because a lot is going on.
Things could change. The U.S. labor market can turn around quickly.
This week, it's all about Friday.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, The second hour of Bloomberg Surveillance starts right now, and your scores. The price action looks like this. Equity futures bouncing back from 2 days of mild losses. On the S&P, higher by 0.2, on the Nasdaq by 0.5. In the bond market, yields higher through yesterday's session. 2s out to 30s this morning, lower by a couple of basis points. We're down 2 on 2s to 423, on 10s to 466. Heading into this, 90 minutes from now, the jobs report at 8:30 Eastern Time. The estimate in our survey, the median estimate, we're looking for something around 80K.
Yeah, the excuse or the reason why the Fed last year cut rates by 75 basis points was weakness in the labor market. It's why it's all the more important to see whether we're actually reversing that at this point. You're actually seeing a re-strengthening of the labor market that has legs. Does the unemployment rate stay at 4.2%? Is that level higher? Are we starting to see the beginning of wage gains, or are we starting to see a little bit of slack emerging that could give the Fed some breathing room come September?
At the end of the day, though, whatever we get for today, everyone's going to be focused on next week. So today is just kind of the appetizer in terms of the data. Because Kevin Warsh yesterday, through people familiar, said to the FT that he's looking at inflation data on whether or not they should, increase interest rates in September. So does today's data really matter?
Look, we're talking about Kevin Warsh and the Fed for good reason. I get it. My focus actually increasingly is on the Treasury and less on the Federal Reserve. The problems are starting to build up for the Treasury. You can see that in the way the Treasury Secretary, Scott Bessent, has responded to it more recently. Issues in Japan. Coming out defending the Treasury Secretary, he can see what's happening with the long end of the curve. It's vulnerable to high yields. And we saw that yesterday just with Alphabet coming out and saying we're going to raise some money. You start to see yields on Treasuries creep higher again.
Forget the players. Look at exactly what the backdrop is economically. You have north of 6% deficit to GDP. You have issuance from all over the world when it comes to government debt as well as hyperscaler debt. We have gone from a financialized market to one that is absolutely industrial revolution, where suddenly people need that capital. It isn't just going to go into a stock market, go into a bond market and accrue interest or accrue gains. It has to go into the real world. This is a vastly different, more inflationary world, and people are grappling with it and saying, what is the right value for these bonds, for this rate? And ultimately, we don't know the answer. So I got to say...
Anchors away, Bramo.
I mean,
away.
I'm here for it. 2028, Penguin,
it's a perfect
House,
thesis.
Whatever place you choose.
It's a perfect thesis as well for what is going on in terms of Treasury stepping in and buying yen, but using euros, because for the Europeans, according to the Financial Times, they were completely caught off guard and unnerved by this. Some of them even saying it's striking and sad what the U.S. Treasury did, because they didn't get a heads up about this movement. So there are a lot of dislocations right now, but the pressure, as you say, is squarely on.
I'm not going to shed any tears for the ECB on this one. We can have that conversation in a moment. When it comes to the Treasury, we're kind of lucky that we have this guy running the Treasury at the moment because he understands financial markets better than most. I'm very, very interested to see what creative ways he has to correct course here, because the former Treasury Secretary has already made the move. She tightened things up, brought a lot of stuff to the front end of the yield curve. She's made that move. You can't do that twice, so that's happened. Japan gets into some trouble, and you can see there is some unease about monetizing dollar reserves. So you start to point to a facility at the Federal Reserve that would allow countries like Japan to park treasuries there and get access to dollars without monetizing those securities. So you can see the unease there to stop yields from going higher. What other options does the Treasury Secretary have at this point? There is no appetite in Washington, D.C. to reduce deficits. There is no appetite to stop investing at Alphabet, Amazon, and others too. What options does he have?
The hopes and the dreams are that the AI revolution will usher in productivity and growth without inflation. This is the nirvana that could potentially bail out a number of economies and a number of different fiscal situations, because then you could grow your way into the debt without the commensurate inflation that is punitive and politically damaging. And that is the hope. The question is how quickly that kind of scenario can come, or if it will come, and just how levered is the entire economic story to artificial intelligence.
They have one creative solution that I always thought they would use before the midterm elections, but it would be incredibly cute and people might just look through it because it would be purely on paper, and they can remark gold. It's on our balance sheet as $42.
That's a wild card.
And 22 cents.
That's a wild card.
It is a wild card. It would be incredibly creative. And honestly, I could see Scott Bessent doing that.
The other one, and there's a massive trade-off involved in it, but the other one is that you have more coordination between the Treasury and the Federal Reserve. And this is what people have suspected for some time, that the Federal Reserve changes the way they do manage the balance sheet. They start to buy a lot more at the front end of the curve. You start to see even more issuance at the front end of the curve. The trade-off, the obvious one, is the dollar gets hammered in that scenario.
I was just going to say, listen to gold. What's gold saying?
Right.
This week, up 6.2%, giving you a sense. Silver up more than 11%. Precious metals starting to speak again.
Futures speaking as well, positive by 0.2% on the S&P 500. Yields slightly lower going into payrolls in 85 minutes' time. Coming up, we'll catch up with Priya Misra of JPMorgan on what today's payrolls report means for interest rates. The Port of LA Executive Director Gene Seroka as Iran looks to ban the US from the Strait of Hormuz. And finally, we'll catch up with Claudia Sahm of New Century Advisors on the lack of communication coming from the Fed chair, Kevin Warsh. We begin this out with stocks little change following 2 days of muted losses heading into the July payrolls report. Priya Misra of JPMorgan Asset Management writing full employment is still one side of the Fed mandate. Our base case is a low hire, low fire, but balanced labour market that is not a source of inflation. Priya joins us now for more. Priya, good morning. Is that what we have already in this labour market?
I think that's where we are right now. Yes, all the underlying data is suggesting that. But I think the bond market is sniffing out, is the economy overheating? Is the inflation, and you can sort of tell, from all of the Fed officials, they're getting nervous. Is inflation becoming sticky? Is there any overheat that they need to actually push back and raise rates? And I think that's why we'll be looking for, are the job gains broadening out? And so if the economy is hiring across the board, it's not just healthcare and education, then that overheat, is the neutral rate moving high? I think that's one question that the market's struggling with. And the other one is, are wages picking up? And so right now, I think we're not there. But given that there's uncertainty about the economic outlook, the Fed is losing patience on the inflation front. And the fact that we don't know the Fed reaction function, there's uncertainty there. I think the market's going to pay attention to that payroll report, even though I agree the more important number is CPI next week. But I think today is important. We'll be looking at the details of that report.
I'll ask the Lisa question. She asked it this week. When someone says we don't know the reaction function, we don't know the Fed chairs that well. Don't we know everybody else's?
I think we're figuring out everyone else's. And it'll come down to the voters, the non-voters, the big discussion, but ultimately, I think the chair is, it is important to see that if the chair is building consensus, that's part of the job of the chair. How does the chair think, so number one, I think the commitment to inflation is there. And the bond market, I think this is interesting, a lot of talk around the confusion, but the bond market, if you look at inflation expectations, very well anchored. I think that's because we understand the rest of the Fed's reaction function. We do want to understand Chair Warsh. The commitment is there, but I think how are they going to get there? I think that's the question. What exactly are they looking for? What's the trigger point? I think that those are things that we need clarity. I'm hoping Jackson Hole provides a little bit of that. But ultimately, it's going to come down to the data. Does inflation suggest that it's already peaked? And, it's starting to head lower. That reduces some of the urgency to hike. And I think then the market can calm down. I think the inflation data is likely to bail the market out or essentially bail the Fed out a little bit.
How, if the Fed does hike in September, how much would that affect the long end of the yield curve?
Great question. If you think the long end has backed up as much because of this Fed credibility issue, then I think that can help. But here's my issue. If they hike in September, how do they signal how many more hikes? The market's pricing in 2 hikes. If the Fed is not going to give us much forward guidance, I mean, we're still going to get the dot. So we'll be looking for the people who are looking for hikes. How many more hikes do they have? Are they reassessing the neutral rate? In that case, if the neutral rate is moving up, and there are Fed officials who think we may have to hike 4 times, 6 times, let's take out all of the insurance cuts over the last 2 years, then the long end can sell off. But if this is a 1-2 hike, we're just trying to gain credibility. I really struggle with the credibility issue. You don't hike to get credibility. You sort of don't shoot yourself in the foot to make sure your gun works. Which would be the credibility hike argument. But I think if it is just a credibility hike, let's just get a couple of hikes done. Then the long end actually can get anchored. But I think the long end, look at real rates, it's much more about supply. Global bond supply, AI supply, high quality supply. I think it's less about the Fed hand-wringing around their reaction function.
Well, based on that, and that's where I was going to go, how much is the AI issuance sucking the oxygen out of the room for all issuance, in particular on sovereigns? I'm just wondering, does that make you feel like the 30-year is toxic until it gets to a comparable level to some of the new levels that we're seeing from the likes of Alphabet issuing $25 billion of bonds and having to offer a premium?
I think the 30-year Treasury has to give us a little bit more yield, particularly because we've got the hyperscaler issuance, which is in the long end. Whether it's this 144A type deals, these SPV structures, whether it's outright unsecured debt, we're getting not just the term premium on the yield curve, we're getting that spread curve as well. So, you know, there's always a price for something. I mean, I wouldn't say I would stay away from the 30-year. At a certain price, it starts to constrain the rest of the economy. Maybe not AI. The AI build-out seems to be interest rate sensitive. But that's one part of the economy. It's a very important part of the economy. The rest of the economy starts to slow down. I think long-end treasuries can make sense. Right now, we'd actually rather own some of long-dated corporate debt just because you're getting that additional cushion. If you're getting 100, 200 basis points more than treasuries, it gives us that cushion that if rates have to rise to, you know, essentially price in all that supply, I've got that cushion in the credit side.
Well, this is what I brought up yesterday to another guest. If they hike rates and the AI hyperscalers, all these companies, it doesn't matter. It's only going to hurt Main Street that actually needs rates to come down. Look how high mortgage rates are.
Exactly, which is why I struggle a little bit with the hike either even for inflation, because if a lot of the inflation is coming from semiconductor chips, do a couple of hikes matter? So this is why I think communication from the Fed's that important. Are they hiking just to get a couple done? Or are they hiking to get inflation back to 2%, which will require more than the 2 hikes that are priced in? But yeah, I struggle with the argument to hike to slow down AI. You're going to need a lot more. But here's the thing. The bond market's doing some of that tightening, right? Real rates have risen. I think that's a function of all of the supply. Spreads are widening. Look at new issue concessions. It's largely in the AI world. But the bond market at some point will take those. That's what will slow the AI issuance. It might just take a while rather than a few Fed hikes.
Are you conveying what you think the Fed chairman was attempting to communicate last week?
I was surprised that he brought up the market that much. You know, you can read it a few ways. If the market's tightening, the Fed doesn't need to tighten as much. But I don't like that chicken and egg, because then the market's trying to see, okay, so should we tighten more? I'd rather that the Fed take control of, you know, where they think policy is. But I think there was another message that the Fed, the Treasury, I think they're looking at the market. This is not an academic exercise of let's figure out neutral rate, where's policy, how much do we need to hike. They're looking at broader financial conditions. You can argue they're easy, and then I look at real rates, and that's not easy. So there is tightening in certain parts of the economy. There's very easy conditions in others. I think the Fed chair is trying to tell us that he's looking at the market. I do still wish we get a little bit more clarity. We don't need forward guidance.
Yeah.
I don't love we're not being spoon-fed. By the way, data dependence was not spoon-feeding. We were looking at the data. So I don't think we need forward guidance. It's just a sense of, you know, how do you react to different economic data points? You know, what is the underlying inflation? Is it PCE? Is it trimmed mean? I think that just would be.
Can I ask you something? This is probably difficult to answer. At some point, obviously, 30-year yields become a buy. But also at some point, you might get to a situation, a scenario where high yields beget high yields and things get away from us for a while. That people start to worry about the financing of the Treasury. Yields go up, and then they start to worry even more, and yields go up, and buyers don't step in. Do you envision that kind of scenario playing out, and is there a level where that might click in?
You know, yes, that is a concern, particularly if inflation doesn't show. I mean, we think it's peaked. What if it continues to stay sticky for a while? The Fed starts to raise rates at the same time as you have all of this supply that doesn't stop, and then the long end gets unanchored. You know, where what stops that would be the rest of the financial markets paying attention to it. I mean, for all of the things that have been thrown to the bond market, we've been in a really 4 to 460 type range. You start getting close to 5, I think the rest of the market, not necessarily just credit spreads, I think equities start to pay attention. And then I go back to the bond market being this powerful equilibrating factor. Yeah. I think that comes in. You get the tightening in financial conditions and some of those things that are moving rates higher. Do we get the BOJ to act? I mean, that would be helpful. Do we get changes in issuance patterns? There are policy offsets, but it'll have to come through a broader tightening in conditions.
Self-limiting at some point, Bramo. It's often the case in the bond market, things become self-limiting. Yields go up so high and then it causes problems elsewhere and the money goes back into fixed income.
As soon as it causes problems in Washington, D.C., then things will calm down.
They might wake up and do something about it. We'll
There
talk more about corrective course in just a moment with Priya Misra of JPMorgan. Let's give you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump reiterating his preference for lower interest rates, acknowledging it's not all on Fed Chair Kevin Warsh.
It's up to him a little bit, but not completely. He's got a board that's very political. The United States should pay the lowest interest rate in the entire world. I think he's great. I won't be criticizing him.
President Trump has reportedly spoken to Warsh multiple times since he took over as Fed chair. Alphabet drawing massive demand for its latest investment-grade bond sale. The Google parent selling $25 billion worth of bonds, attracting roughly $115 billion of peak demand. The company has raised more than $110 billion in debt since last year. The FAA is asking U.S. airlines to inspect their fleet of the latest Boeing aircraft. Operators of more than 450 737 MAX jets have been advised to check for cracks on key components that could undermine the aircraft's structural integrity. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Vonnie, thank you very much. Up next on the programme, opening Pandora's box.
I give them credit. Their intervention was very deft. Opening that Pandora's box where you can say, yeah, we don't like the level, so we'll pop into the market with a couple of billion. That carries a lot of risk as well.
Up next, we'll catch up with Priya Misra of JPMorgan on what's happening in Japan and what it means for this Treasury market. .30 Eastern Time, the jobs report, 80K, the median estimate in our survey. That number drops in about 1 hour and 11 minutes time. In the equity market on the S&P, positive by 0.2%. In the bond market, 2s, 10s and 30s. Yields retreating just a little bit. We're down a basis point at the front end of the curve and down 2 on 10s to 466. Under surveillance this morning, opening Pandora's box.
There's dangers to, trying to short the yen. I give them credit. Their intervention was very deft. So I think the market is going to be cautious about going in with both hands again. Opening that Pandora's box where you can say, yeah, we don't like the level, so we'll pop into the market with a couple of billion. That carries a lot of risk as well.
So here's the latest this morning. The Japanese yen losing nearly half of its intervention-fueled gains. Last week's effort by the US and Japan coming to the surprise of key allies. The Financial Times reporting the ECB only learned of the move after the US government sold euros to buy the yen.
Yeah, really highlighting just how unusual this moment is. We've been talking about that in general. The first coordinated bipartisan intervention between the U.S. and Japan going back some 30 years. I mean, this question of exactly how unprecedented it is, European authorities saying to the Financial Times that the sales of the euros to finance the yen were very striking and sad, saying this has never happened before, and that typically there always has been close coordination between Western allies. Again, it speaks to the bilateral nature of so many agreements in today's world versus some sort of multilateral kind of coalition type of approach that has been taken in the past.
And maybe at this moment it helps Tokyo and Washington. So you can see why both these governments were in favor of it. But to do it through the Europeans and not give them a heads up, for the Europeans, it goes against basically the structure of the G7 coordination, the Plaza Accord. And that is why they are so unnerved by this move. And everyone's asking, well, can we see it again? That's the big question.
Priya Misra of JPMorgan still with us. Priya, let's just continue this conversation. The Japanese have now got access to a vehicle at the Federal Reserve. Make it very simple. You can park treasuries there, get access to US dollars without needing to sell those dollar reserves. Some people are having a debate right now about whether that is good or bad for the reserve currency, given the unease from the Treasury around monetizing those securities. What's your take on that?
I think it's great. I mean, treasuries provide a lot of value to portfolios. Liquidity is one of them. If I don't need to sell my treasury to get that liquidity, that, I think, reinforces that liquidity aspect. And then I go back to the COVID dash for cash. This facility was not available. A lot of the selling of treasuries happened because people said, I need cash, particularly central banks required cash. They were intervening or they just needed dollars. They sold treasuries. The market structure of the treasury market has changed, meaning we just don't have enough dealer intermediation capacity, regulations have changed, and so then all of that selling can overwhelm the market. If you have this other area where you can still monetize that liquidity benefit of treasuries without overwhelming the market with treasuries that somebody has to absorb at the same time as all of the supply, the credit supply is coming in, I think it's actually a very innovative, smart way to reinforce that within the construct of they're not doing anything that the central banks anyway, park their treasuries at the Fed. So this is just allowing them to to monetize.
Goldman agrees with you, others do too, and for good reason. And we all remember what happened in COVID, Bramo, that sell what you can, not what you want dynamic, where things started to get better and then yields started to rise on treasuries too. And there were those kind of moments where you knew things weren't good.
Yeah, and typically if you have a backstop, that's a positive, and the Fed or the Treasury can provide that backstop, and that's a real positive issue. It kind of goes to the crux of the issue that a lot of people are talking about. Does Sell America take hold once again on the heels of concern about a Treasury-Fed accord or just a lack of certainty, or do you think that those fears have been overblown?
I think they've been overblown. I mean, they were talked about last year. We saw no evidence of that. You know, I look at inflation expectations very well anchored. I mean, is there a repricing in the bond market because of all the supply? I think that's happening. The real rate is showing you that. And that, you know, so that can happen. I might want to get paid a little bit more to give the US government's money for longer, or a high-grade corporate money for longer. But that's not Sell America. That's competition for capital, which is happening globally because sovereigns are issuing more, the AI build-out. But that's just, we're all trying to get those same funds. People are looking at all-in yields. And I think that's why we're continuing to see inflows. People see there's income in fixed income. You're getting 6-7%. I'll buy that. So I think Sell America is overblown. Now, if credibility, Fed credibility is at stake, which I don't see that, but if that starts to happen, you see clear political interference, that can change. But I don't see any evidence of that right now.
Given the race to capital, we hear about creativity coming from the Treasury Department. We hear about creativity coming from the AI issuers. You hear about creativity from all of the bankers at a time where everyone's looking to raise money. At what point is the creativity concerning?
You know, if we're seeing the impact of all the build-out through productivity, I mean, that's the holy grail. Is this going to just make us all more productive? Is it going to bring disinflation, back in the system? Then the creativity is fine. If leverage starts to build, leverage, I mean, we just lived through the last month where we realize how toxic leverage can be. I think that's where the concern can come in. I still look at much of that creativity is coming from companies with pristine balance sheets, barely any leverage. So I think they have room to run. The US government, I think we've got the safe haven status for us. I'm not sure where, at some point, Congress has to get the memo. I'm not sure that's happening anytime soon. But I'm less concerned about all of the supply right now because there is, there's earnings to back it and there's a good balance sheet to back it.
Priya, just final question on the Treasury. What options do they have left? What does a corrective action look like from here?
So I think the Treasury Secretary, I mean, they want to do regular and predictable issuance, I get it. But I think if they look at the broader fixed income complex of high quality paper, there's a lot happening in the long end. Maybe the Treasury doesn't need to compete for the long end. Issue a bit further in. I know Secretary Bessent didn't like what Yellen did, but you know what? They can do the same thing. They can start to, they can say there's a lot of demand for 5-year paper. Let's increase the 5-year. They don't need the Fed to buy. We'll buy, the index community will buy. So I think reduce some supply in the long end. I think that's coming in the next few years.
Priya, thank you. Priya Misra there of JPMorgan. That is an option available just to do even more.
Well, Gennady Goldberg actually thinks that that's exactly what's going to happen, and that the 30-year issuance, like Priya was saying, will come in, not expand.
Interesting. Up next on the programme, we'll catch up with the Port of LA Executive Director Jean Seroka as Iran looks to ban the US from the Strait of Hormuz. Plus, Yahira, how's your morning movers? Chip makers looking to rebound in early trading. Micron up by close to 2%. SanDisk up by 2.5%. Stocks doing better, up 0.25%. We'll see what the jobs data brings in about 60 minutes from now. We're following 2 days of really muted losses on the S&P. No drama there whatsoever. Pulling back just a bit from all-time highs on the S&P this morning. Back higher again by, let's call it 0.25% and up by 0.6 on the Nasdaq 100. The talk of the bond market right now, less about the Federal Reserve and much more about Alphabet. 2s, 10s and 30s. Yields lower this morning but high yesterday. Across the curve, including at the long end. 30s. Of 521.
Yeah, Alphabet selling another $25 billion of debt, and this comes after already about $170 billion of debt sold by just 3 issuers so far this year, which gives you a sense of just how significant this glut of borrowing has been. A key question, how much is this the real reason that you're seeing the long end of the yield curve really shift up in yield, just simply because there is so much supply? Ultimately, a significant portion of this is coming at the long end, the longest piece, 40 years. So this is where your duration is, and this is where your supply is.
40 years.
I know.
Where are we in 40 years? Where will we be? Right?
I'll be.
Where will technology be?
Baking cakes.
2066.
Fixing toilets.
Right. You know,
that's pretty much all I can think of.
Fixing the air conditioning at a data center.
Unless the
just
robot
sort of everyone
can do
lining
it
up for
itself.
those jobs.
I mean, that's right. Or building.
We'll be retired in Puglia somewhere.
Hey, we better be.
Yes, that's what we're putting out into the world,
that's
Jonathan.
The dream.
Come on.
We better be. I'll be there. 2 hours away from the cash open with your morning move as Yahara has more. Hey, Yahara.
Hi, John. We are seeing the chips and data storage companies staging a comeback this morning after yesterday's tough sell-off triggered by results from SanDisk and Western Digital, which were good, but not enough to satisfy investors who were looking for even more from this year's biggest winners. Because remember, SanDisk up more than 350% year to date, Western Digital up 140% year to date. Meanwhile, Hertz is surging again by double digits after soaring 30% yesterday as better than expected results give investors confidence in its turnaround story after it lost less money than Wall Street expected and posted better than expected profit. Also, heading into earnings, the stock had one of the highest short interest on Wall Street, so short covering could be adding fuel to this rally. And we end on software with Atlassian soaring 28% in the pre-market, making back almost all of this year's losses after it was caught up in the SaaS apocalypse. It beat and issued a stronger than expected outlook, and it's a sharp contrast to yesterday when disappointing results from Datadog and Figma sent the software sector sharply lower. John.
Yahara, thank you. I think everyone still trying to come to terms with Bramo's retirement plans. Which sounded
it doesn't make any
deeply
sense.
depressing, didn't
yeah,
they?
cakes and toilets, no thank you.
They really,
I won't be baking any cakes or fixing any toilets in my retirement
no wonder she's
plan.
so bearish on the future and financial markets. I mean,
just, live within your means.
Okay, on our radar this morning, not that, but this, the president maintaining U.S. control of the Strait of Hormuz.
It's sort of open right now. You know, we have a thing called the blockade headed up by the U.S. Navy, and we control it. Now, we control it, but they can always shoot something. They always have something or drop a mine.
Tehran reportedly attacking, quote, hostile targets in the Strait overnight. Iranian state media reporting the country aims to ban U.S. and Israeli ships from the waterway. Elsewhere, Alphabet returning to the debt market to fuel massive spending on AI. The company raising $25 billion in investment-grade bonds, securing one of this year's largest order books for AI-related debt. The offer attracting about $115 billion of peak demand. And finally, the former PIMCO CEO, Mohammed Al-Arian, claiming Fed Chair Kevin Warsh is, quote, being misread. In an opinion piece with the FT, Al-Arian writing the following: should the market stubbornly fight the Fed, the risk of financial instability that has been building would intensify.
We've seen an increasing number of big thinkers, prominent people in the bond space talk about how Kevin Warsh is being misunderstood, that he wants to bring inflation down, and that the market has just gotten used to being spoon-fed or having sort of their hand held, all this type of rhetoric that we've heard. Ultimately, other people have said, well, it's a reaction function, not necessarily forward guidance. I think the bigger issue is we don't have a sense of what the actual threshold is, and the data is unclear. And frankly, the dynamics are unclear. And my biggest question from the entire thing is just, do you want to lean on the front end to do the work to reducing inflation, or will you let the long end do the work for you? Is that a better way to try to bring in inflation? Because ultimately, that was the interpretation of markets last week. And is that what they want to send out there? And that, I think, is sort of a bigger question.
Mohammed has real credibility in this, not just because of his experience, but because of what he was saying during the Powell era.
Yeah.
For the entire time, Mohammed was begging them, look at where inflation is. Look at where inflation is going. And now, all of a sudden, because Kevin Warsh is coming in as Fed chair, everyone on this deliberative body actually now realizes, oh, wow, we are so far above our target. And how the heck are we going to get back to 2%?
I spoke to Mohammed yesterday, and he gave me a heads up that this was coming out. Didn't tell me what was in it, but told me it was coming out. So I read it first thing this morning. And I actually think the most important piece of this piece this morning is at the very end. The last paragraph. And what Mohammed's getting at is less about reaction function versus forward guidance. It's reality. It's the reality of the backdrop right now. that is forcing the central bank to go through much needed changes. And I'll share the last paragraph for those who haven't read the piece in the FT this morning. Ultimately, the era of central banks as indiscriminate shock absorbers and perpetual providers of forward guidance is inconsistent with today's geo-economic realities. Success in this new regime requires abandoning the misleading comfort of the old playbook. It is very hard to disagree with that statement this morning.
Yeah, and I would argue, though, to what Priya was saying, it's not as though data dependence has been a comfortable existence for a lot of people. And that is sort of the counter argument to this, is we're already out of that place where people were looking to the Fed to bail it out. No one's talking about more rounds of quantitative easing. I hope not. But right now we're talking about just how do you adapt to a difficult scenario to forecast, and difficult moment to understand inflation. I think a lot of people are on board with the 5 pillars that Kevin Warsh is talking about, analyzing all of that. Here's the conflict. How do you navigate policy before you get any conclusion or credos from some of those policy panels? I mean, that's the difficult thing. Do you not act at all, or do you just let the market do your work for you? I mean, these are some of the questions that people are trying to analyze. I don't think anyone would disagree with Mohamed El-Erian in that last paragraph.
It's a process, and a messy one at that, and we're still working our way through it. Let's talk about a messy process developing in the Middle East. Iran seeking to prevent US and Israeli ships from entering the Strait of Hormuz. A potential deal with Oman could grant Tehran tighter control of the waterway. The Port of Los Angeles Executive Director Gene Seroka writing, regional instability continues to affect global shipping by increasing fuel and transportation expenses. Those higher costs ripple through the economy, ultimately affecting businesses and consumers alike. Gene, I'm pleased to say, is with us here in New York. Gene, good morning. Good to see you.
Good to see you, John.
How has that instability changed your world in the last 5 months?
It's been really unbelievable, because while there's about 10% of worldwide cargo that goes in and out of the Middle East, it's taking up 95% of everyone's time in the supply chain. New base cases on prices of energy, new base cases on how waterborne deployment architecture is going to look on these big ships and where they're going and how we're going to handle the cargo. Case in point was this summer. You saw a lot of small to middle-sized importers bringing in their cargo earlier because the fuel prices were going to go up. They lagged by about 3 months in the industry. And you had a target date of those tariffs, the Section 122s, going offline on July 24th. So we saw an abnormal rise in cargo May, June, July, ahead of a traditional peak season.
And we've got problems in the Red Sea now as well.
4 years now, John. The Suez Canal receipts are down 80% on average, which means the shipping lines take a longer route around the Cape of Good Hope of Africa, adding 14 to 17, maybe even 21 days longer on transit time. Now, with the price of bunker fuel up 60% since February 28th, that means the spend on each one of those vessel voyages is so much higher.
Are vessels and shipping companies just prepared to live through this? As you said, 4 years you've been doing the Red Sea. Are they prepared to live through the Strait of Hormuz that's off and on like a light switch?
Yeah, I don't think anybody is sitting back, Annmarie, saying, you know what, this is just the way it's going to be. But the amount of time that's being invested in scenario analysis, whether it's the importer, exporter, shipping line, 3PL logistics company, has just been off the charts. What do I do if this happens? There are so many announcements, once again, emanating out of Washington. This whipsaw effect of information has got people just planning as much as they can and then executing to the best of their ability.
How expensive is it to take these routes?
These routes add so much time, and the fuel burn at these elevated levels. You're talking about prices that are up 60% over the last 6 months. On average, the transit time has increased by 2.5-fold. And right now, the fuel burn is about 30 to 35% of the cost of a vessel voyage. One ship sailing, 35% is what you're looking at on the energy price.
What I'm struck by is how we've had one supply shock after another. And people keep saying, well, at first it was transitory. The second one, it was just inconvenient that one shock came after another. And now people are saying this is the new normal, that a lot of the old rules are breaking down, the sort of free traverse of the seas kind of dissipating. How do your clients think about these supply-side shocks when it comes to the influence over their prices and how they plan for the future?
The question really is to that, how much more can we take? We go through COVID, we had 109 ships backed up in LA and Long Beach because people were buying so much product and then sitting on it, like a warehouse complex at the Port of Los Angeles. And then we go through the tariff policies and the reaction from overseas markets where we're now out of the ag sector, soybeans moving out of Brazil, Argentina, almonds from Australia, and then import shifting with windows of opportunity and folks just speeding product to market. So it's not consistent. And that's what many of the questions are. When will we get to a day where there's consistency? And if it's a new normal, at least put these policies in place where we can kind of predict what's going to happen.
Well, I guess that if it's the new normal to some degree, or as people struggle to keep up, can they just raise prices? Is that a lever that they can keep leaning on to offset the extra costs incurred by the inefficiencies and the disruptions?
Not always, and I'll give you one example. With the price of energy across the board going up, diesel prices in Southern California are up by about a third. Most of the truckers that do our business at the port, about 2/3 of all the cargo moves in and out over the road, they're small to mid-sized businesses. They can't absorb these price shocks like others can, and they can't necessarily pass it on because they don't have the leverage. So there are different segments in this. The retailer passing it on, absorbing, finding efficiencies in their supply chain, better chance than some of these service providers that are really doing the business every day, our first and last mile ambassadors.
Gene, just final question. It's Payrolls Friday, so we talk about the jobs data. What's the labour market movement look like in your industry at the moment? Are things getting tighter? What's access to talent shaping up like?
Yeah, generally speaking, we're in pretty good shape. These dock workers, the best in the business, moving all this cargo, our daily stats have never looked better from an efficiency standpoint, how much cargo is moving in and out. Even with the changes in commercial driver's license and truckers, we're still in very good shape for the 17,000 that are registered to do business.
No tightness emerging on the horizon?
Not that I've seen, no.
Okay.
But even at elevated levels, you got to do better with your gate appointments. You got to make sure that you're loading these trains on dock quickly and moving them through the Alameda corridor. It's all about speed and efficiency, and so far we're staying ahead of the curve on that.
A man in command. Gene, it's good to see you. Appreciate it. Thank you, buddy. Gene Seroka there, the Port of Los Angeles Executive Director. On the twin shocks for that industry right now, rerouting is one, the trips are longer, and on top of that, you've got higher energy costs as well.
Yeah, and you've got potentially policy uncertainty with respect to the tariff backdrop and a whole host of other things. It's been a complicated period of time for this, and it's one thing if you're a Walmart or if you're Amazon. It's another thing if you're a small business that's trying to navigate this with smaller margins and less leverage.
The costs are going up. That's the end of that's the end of it. Either you're taking a longer route, which you have to use more energy, or you might actually try to traverse a conflict zone, and then your insurance cost is going to be extreme and probably not what you had it planned or budget for the year.
The trade-offs, it gets harder and harder, that's for sure. Let's get you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Kentucky Senator Mitch McConnell has been released from a rehabilitation centre to recover from home. The 84-year-old Republican saying in a statement he'll continue physical therapy and his work on Senate business. It's unclear when Senator McConnell will return to Capitol Hill. A hospitalisation has kept him away from the job for nearly 2 months. Moonshot's AI model Kimi K3 broke out of a cyber testing environment. The test, performed by Frontier Security, shows Kimi lacks cyber controls. Moonshot joins other AI companies including Anthropic and Meta in reporting their models have escaped testing environments. In sports, FIFA's controversial water breaks introduced during the World Cup may be here to stay. Early stage talks are underway to sell US media rights for the next 2 World Cups together, which would keep the breaks in place after they helped power this year's tournament to FIFA's most lucrative ever. And that is your Bloomberg brief. John.
No. Vonnie, thank you. It's just, why?
I'm sorry, I'll be right back. I'm going for a hydration break.
You can take as long as you want. I could talk all day about how
can have hydration
bad
breaks with
this
us.
is.
We could just have, an advertisement. Bake it.
It's so obvious now, right? Because they're just saying the quiet bit now, out loud. They're not even hiding it. Not that it was well hidden to begin with.
I mean, in fairness, the NFL puts everybody to shame, so it's not exactly like.
I respect them more that they've actually tackled it head on, explaining to us why they have hydration breaks instead of,
for commercial reasons.
all of a sudden,
yes,
all of a sudden the players need H2O breaks when this has been going on for years
you could see
without
how
them.
the momentum in those games switched around those breaks. Like you really could. Just watching it as a neutral observer, you could see how the momentum shifted one way to the next based on a hydration break that none of them needed. In fact, the goalkeepers sometimes were signalling for the hydration break because they could feel the pressure building at certain points, and and wanted a break.
I'm thirsty.
Yeah, I'm just sort of sick of it. Anyway, the World Cup withdrawal for me is over.
Yeah,
so
I think a lot of people.
I was longing for
Premier
Portugal,
League.
Uzbekistan maybe like 2 weeks ago, but
not anymore.
Well, Premier League is
Too much
just 2 weeks
Infantino in the
away.
news.
it's almost back. Yeah.
Yeah, we're fine.
Up next on the program, guiding financial markets.
Communicating your framework, guiding the market as to what your thinking is, what your framework is, not just the objectives, not just the targets, but how you intend to achieve those objectives and targets is pretty important.
Claudia Sahm of New Century Advisors joins us next. Stocks positive this morning. We're up a 0.25% on the S&P, on the Nasdaq higher by 0.6 with jobs data 42 minutes away. We're looking for 80k. In our survey, at least, that's the median estimate. In the bond market, 2s, 10s and 30s shaping up as follows. Yields this morning down across the curve. We're down 2 on 10s to 465. Under surveillance this morning, guiding financial markets.
Communicating your framework, guiding the market as to what your thinking is, what your framework is, what you're concerned about, I think is important. The markets can then make their own decisions without any commitment. But communicating the framework transparently, not just the objectives, not just the targets, but how you intend to achieve those objectives and targets is pretty important.
So here's the latest this morning. Communication for the Federal Reserve dividing Wall Street and Washington. A growing list of Fed officials sending new warnings on inflation after last month's decision to hold interest rates. Claudia Sahm of New Century Advisors saying Fed Chair Kevin Warsh needs to start paying more attention to the people, writing the Fed does not need a new task force to hear from the public. It just needs to listen to the Americans it is already talking to. Unfortunately, the signals they're sending are not very encouraging. Claudia joins us now for more. Claudia, it's good to catch up with you, as always. What's the message from the American public?
I think it's a message of some weariness, right? This is, and Kevin Warsh has talked about this. Inflation has been high. It's been high for 5 years. People have been adjusting to it, but adjustments are costly. Trading down, looking for deals, like that takes a lot of time. And I think that's some of the frustration we pick up in the sentiment series. People are still spending, but they're angry and they have reason to be. And the labor market, while we call it balanced and it's stable isn't always a good thing. If there aren't job opportunities out there, you're stuck in a job, you're not getting higher wages. So under the surface, there really is some strain. And I think it's important for the Fed to be listening to it, especially for the chair. The task forces, regular people, totally missing. Labor organizations, nonprofits, totally missing. So, but all that information is sitting at the Fed. He just needs to spend some time really thinking through it.
Those problems are real. That strain is evident. It's clear to us all. Claudia, what could this Fed do about them?
I think this is one piece where the communication strategy needs to get back on track. Communication is not just about talking to financial markets. It's about talking to the American people. The accountability piece, like, let us believe that you know what you're doing, that you're thinking. Like, we can't just trust you. We need to kind of see that evidenced. And so I think that's one where really getting back on track with the communication would help a lot. But in the end, it's gonna be actions. It doesn't mean that they should be raising rates just to get people on board, but they really should lay out a very clear, well-argued, well-thought-out plan and then move forward.
Claudia, what do you think that plan should be? I mean, if you had to articulate a reaction function right now, what would it be?
So I found the reaction function in the June FOMC minutes, a very credible one. They had two scenarios. Either you start seeing inflation coming down soon, and I think it is important to put some timestamp on it. Like, we're not talking about 2 years from now, we're talking about this year. Then you start raising rates as long as the labor market is stable. And if things start to get better, we've got some supply issues. If they're working their way out, okay, then the Fed can sit back and watch that carefully, let inflation come down. But it needs to be scenarios, contingency plans that are tied to the data we have. No, it is not perfect, but it's the data we have, and then you go forward from that. I think that's the way to do this.
What do you think is the more efficient way to control inflation? And this is something that's emerged kind of in markets. Do you think it's the front end of the yield curve? It's the Fed funds rate, which is the traditional tool. Or do you think allowing longer term yields to go higher is a restrictive way to bring down inflation without having to take action on the front end that could potentially penalize certain investors with credit card loans, et cetera.
So the most efficient way to get inflation down is to stop doing policies that pump costs into the American economy, right? Like this has been a real issue, particularly in the last year. But in the Fed, what I think they should really stick to their bread and butter, do this through the federal funds rate. Don't get cute with the balance sheet right now. The Fed has the most impact at the short end, but that's not the only place that it has an effect. And so I think it's just, if inflation is high, if there is a risk that it is getting stuck, you have a tool that is there. You can raise rates. I do think it's important that they're going to need to give some guidance on the fact that we're talking about an adjustment, something modest, not a 5 percentage point hiking cycle, right? Like they need to give some sense of what the Fed is trying to accomplish here. The Fed cannot fix all of this inflation, but it can definitely be part of the solution.
Claudia, when you talk about this accountability issue, isn't the issue with the entire Federal Reserve not the Fed chair because they don't trust Team Transitory and some of them are still there from the Powell regime?
I question that the Fed had that view before. I mean, I know that is the kind of talking point of Warsh, that he's coming into a Fed that's in crisis, has lost credibility. My read of financial market data, financial market discourse was not that the Powell Fed was completely, under the bus when it came out of office. I do think there were periods in 21, 22 where the Fed was really questioned, but they pivoted, they raised rates a lot. Inflation did move down, not all the way to 2%, but I don't think we're at a point where the Fed has been in this crisis moment. And frankly, the reason I point to Chair Warsh as the one who's out of step is the rest of the committee, if you watch them, they really are still communicating as they have done in the past.
Claudia, it's good to see you. It's what we see right now from Fed officials. They won't stop communicating. Claudia Sahm there of New Century Advisors. As for the history of Fed Chair Jay Powell, I often say this. They were late. And there were individuals on that committee that suggested they were late because they were waiting for the Fed chair to see if he got reconfirmed.
Exactly.
That's a problem. The other issue I would bring up with regards to this Fed too, and we can't forget it when we talk about these issues, is that the correction we saw in inflation, a large piece of that, particularly on the Labour side, was a consequence of some very questionable policies from the Biden administration about how they handled immigration at the southern border. There was a massive supply side story that we see the opposite of at the moment under this admin.
Also, extra checks to people who are working at home and receiving income and didn't have anywhere to go spend it on.
True.
That was a huge issue in terms of why you saw costs of furniture and contractors go up. The issue, of course, with Powell was they were waiting for him to be reappointed, so which was politically driven.
We're still doing QE at the time. That's why it was a mess, let's put it that way. A regrettable mess. Coming up, Nadia Lovell of UBS, Greg Peters of PGIM, Stephanie Roth of Wolfe Research, Jeff Rosenberg of BlackRock, the third hour of Bloomberg Surveillance. Up next.
We think we're in store for some weaker reports upcoming.
The labor market's still relatively sideways.
The signals are muddled. They're not telling you what they typically tell you because a lot is going on.
Things could change. The U.S. labor market can turn around quickly.
This week, it's all about Friday.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. 30 minutes out from the jobs report, with equity futures on the S&P up by 0.2%, on the Nasdaq up by close to 0.5. In the bond market, yields declining across the curve by around 2 basis points, down 2 on 2s to 422, on 10s to 466. Heading into this at 8:30 Eastern time, we're looking for 80K. In our survey, that is the median estimate. That is up from a previous read of 57.
Yeah, and a real question here about some of the internals, what it will be. Right now, the expectation is for the unemployment rate to stay at 4.2%, the same rate that it was in the prior reading. That will be key to understand exactly the tightness versus slack that could be emerging in the market. And then again, the wages. The wage picture directly goes to the question of how much heat is there coming from the labor market, potentially going directly into next week's CPI and beyond.
And I know the survey's for 80K, but the scope and the range is so wide, 40,000 to 157,000. That would be a pretty large number right now. But once again, does it tame down expectations of Fed rate hike, or does potentially it make next week's CPI a little bit more spicy?
We've got 2 more CPI reads, 1 more payroll read after this one, going into that September meeting. And you're hearing from more and more officials that are either ready to hike or close to preparing to hike. That's the overwhelming consensus on the committee right now. And the one person that hasn't really offered their view in a material way is the Fed chair himself. And the only read we've really got at the moment on that, with regards to September specifically, is through that FT story just yesterday.
That he'd be prepared to raise rates should inflation run hot, and that his reaction function isn't that far away from some of the other Fed officials, that ultimately the threshold is inflation continuing to accelerate in the wrong direction. Key question for a lot of people is, why wasn't the communication talking about how inflation still was going down in certain key components, right? In other words, you talk to a number of analysts, and they say they still are expecting disinflation coming from components like the housing market that's only more constrained right now, and a couple other places. If that comes to fruition, does the market price out the potential for rate hikes?
You know what stood out to me about the FT piece that really spoke to how communication has broken down? That the people familiar with the Fed chair's thinking felt compelled to tell the FT that the primary tool was still the interest rate and not the balance sheet. That just spoke to me that communication's really, really gone wrong here. The fact that you have to say that, like, out loud because people aren't quite sure, that's what went wrong in the news conference last week.
To me, that is the ultimate question. Are you still relying on the front end of the yield curve to control inflation, or are you going to take a look at other metrics? And if you are, then people are going to price in the potential reaction function of the Fed very differently. I think that is the question, not necessarily whether we're going to get reaction functions from the Fed, not how many press conferences there is. It's what tools are you going to rely on, and how do you plan to evaluate inflation and progress potentially in that area?
Above target inflation is a problem. You've acknowledged that. We've seen it. It's in the statement. What are you going to do about it?
How?
Right? And how? What tool are you going to use? Still big questions. Yields this morning down a couple of basis points, 10's around 466. That jobs data 26 minutes away. Coming up this hour, Nadia Lovell of UBS with stocks eyeing a second straight week of gains. Greg Peters of PGIM expecting a rate hike from the Fed this year, and Stephanie Roth of Wolfe Research calling for an above consensus payrolls print. We begin this hour with stocks holding steady heading into the jobs report. Nadia Lovell of UBS writing, "We are constructive but not complacent. The Fed likely stays on hold. Earnings remain the market's anchor, and we think the next leg higher comes from continued broadening beyond mega cap tech." Nadia joins us now for more. Nadia, good morning. We love sharing Payrolls Friday with you. Walk us through what you like and how things have changed since we last spoke.
You know, I think we continue to emphasize this broad in and out story, and we've had increased conviction after this very strong earnings season. I mean, it's coming above even our expectations. I mean, trending close to 30% EPS growth. And I think that the good news in that is that you are seeing that broad in and out of earnings. It's not just about mega cap tech anymore. You're seeing like 8 out of the 11 sectors that are now seeing double-digit earnings growth. The medium companies is seeing earnings growth in sort of the low teens. And I think that that sets up for a better second half from here. And the fact that you have the S&P 500 that is close to all-time highs, but the last couple of months, what's gotten us here? It's not necessarily sort of the old story. It's the financials, it's the industrials, it's the healthcare. So our message remains consistent, and we continue to emphasize that you need to have diversification across the portfolio into all this, some of these other cyclical areas as well.
7,900 used to sound like a big number. We're really close to it now. That's your year-end price target. Yes. When you start to see that broadening out away from mega cap tech, if leadership is elsewhere, does that mean index level gains will be muted from here into year-end?
No, you know, I think that, you know, now that number, I would say, is looking conservative after this earnings season. Even our earnings expectations for the year of 20% is also now looking conservative. So what gets us to the upside from here, I think, is that continued strong economic growth coming through, and we think that happens. A Fed that stays on hold and not flip to a hiking cycle, because then the market will question, is it one hike, is it two, or is it three? And then the Fed reaction function isn't quite as clear in this moment either. And so we think that you need some clarity around that in order for markets to continue to grind higher and this earnings support coming through as well.
In other words, if the Fed hikes one time or even two times, that could potentially stymie the momentum that we're seeing in the broadening out and in equity markets more generally?
I don't think it's necessarily one or two times. I think it's more clarity in terms of like, okay, what exactly are we solving for? Are we looking to remove all of the cuts that we've had in the last year or so, 75 basis points or something more? You know, the equity market doesn't need certainty, but it needs some sort of direction of travel of where we're going. The fact that you have earnings growing close to 30%, I think that that's enough to help this market continue to move higher. But what you need is that a Fed that doesn't necessarily, emerge into multiple hiking cycles or sort of renew a hiking cycle.
Can you have earnings growing by 30% without a heating economy or an overheating economy?
We're here. We're doing it right now. Well, but let me explain. Yeah, let me explain. I mean, we're already seeing it right now, where the economy isn't overheated. I mean, some of the things associated with inflation, we know it has to do with tariffs. It has to do sort of this temporary spike in oil prices, and so we do expect to see the disinflation trend continue. When we look for CPI next week, we're looking for about 2.5% increase on CPI. We think that this is an economy that can grow in a 2% range. And so I wouldn't put that as an overheated economy. You also have a labor market that is not re-accelerating. It's sort of, yes, the unemployment rate seems to be stabilizing around 4.2, 4.3%. You're not seeing wage growth pressure. So you do have an economy that is moderating, or it's slowing down. It's not overheated. And what's driving the earnings growth is really, one, we know the capex coming through from tech, but also the fact that you're now seeing a cyclical pickup, improvements in PMIs as you have clarity around, tariff policies and some other pent-up demand that's actually now being solved for. And we heard that from the industrial companies, that it's not only short cycle, but also you're seeing improvement in terms of aerospace and defense, transportation, also related to the data center built out. So I think it's all a combination of that, and you have an economy that's healthy, that's not overheated.
Nadia, does it give you pause, though, that the Bank of America sentiment gauge hit the most extreme bullish level since 2021?
Well, I'm not surprised by that, because there are a lot of reasons to be bullish that we just talked about in terms of the fact that you have, 7 consecutive quarters.
But if everyone's lined up on one side of the boat, does that make you a little bit nervous?
I wouldn't say everyone is lined up on that side, because this is despite the fact of what that specific survey they say. And you've seen that.
I liked Chris Verrone's response to this. You need bills for a bull market.
Yeah, exactly.
But
stocks are going up.
Yeah, but look at it. Look at some of the positioning, the unwinds that we've seen also as well. That hasn't fully been reloaded, right? So I don't think that there's broad-based, like overly bullish. There are a lot of bearish
Nadia,
people
that's
still
of
in the
interest
market.
to people. Can I jump in? Just how much we cleaned out leverage through the month of July? How much of a reset we actually had? What are your views on that, and how do you gauge where we are?
I think that it feels like a lot of that unwind is behind us now. You're already seeing some recovery in the names that have been affected. Could you see another leg, so continued volatility in the next couple of months? Yes, you can. But I think a lot of that is now behind us. We ourselves, in terms of our position, and we had taken down semis quite a bit over the last month or so, started in June, because we were a bit concerned about how fast that they're rally. We still believe in the fundamental AI story, but what we're trying to send through to our clients and in our portfolio is the need to be selective and diversified across the AI space. So I think it's from here on out, it's more selectivity. You're seeing it in terms, even some of those earnings results this week, that the bar is quite high, right? And so companies not only have to deliver on the earnings, but also the outlook, and also show that sustainability of the margins, particularly around the AI trade.
You crushed it with that call. Just finally on the jobs data, 20 minutes away.
Yeah.
How relevant is the jobs data? this morning.
It is relevant from the sense of the unemployment rate and wage growth, right? But it's not the only data that matters next week. CPI inflation will matter, of course. Obviously, we're all watching it closely because we're still trying to figure out what the Fed reaction function is. And so, you know, if you see a tick down in the unemployment rate, we know payrolls get revised all the time. So unemployment rate, then that's, you know, an argument that helps support the more hawkish side of the Fed, like the Kashkaris of the world, that believes that we should be on a path to moving interest rate back up higher. Or, you know, if you see a sort of stabilization, then, you know, maybe you're supporting the Williams of the world, who sort of said policy is well positioned. So I think that the fact that we have a pretty, you know, bifurcated Federal Reserve, that those two numbers will be watched closely. But our core view is that the Fed remains on hold for the rest of the year.
Nadia Lovell of UBS 7900. What's the bull case? What's the bull case for you?
82.
OK, it feels like we're leaning towards that. All right, Nadia, thank you. Appreciate it. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Iran looking to block US and Israeli ships from the Strait of Hormuz as part of its proposed deal with Oman. Tehran also moving to require compensation from hostile countries before they're allowed to sail through the crucial waterway. President Donald Trump reiterating his preference for lower interest rates, acknowledging it's not all on Fed Chair Kevin Warsh.
It's up to him a little bit, but not completely. He's got a board that's very political. The United States should pay the lowest interest rate in the entire world. I think he's great. I won't be criticizing him.
President Trump has reportedly spoken to Warsh multiple times since he took over as Fed chair. Under Armour forecasting a sharper than expected revenue decline due to softening demand in several regions. The athletic retailer now expecting sales to fall by mid-single-digit percentages this year. The company's CEO citing a, quote, challenging consumer environment. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. More from Vonnie in about 30 minutes' time. Up next, the morning calls, plus Greg Peters of PGIM, seeing rate hikes on the cards later on this year with a payrolls report about 20 minutes away. We'll catch up with Greg in just a moment from New York City. You're watching Bloomberg TV.
We're entering the alpha market, right? This is a market where, you know, I think ambiguity is greater than people are used to. I think it's an environment where there's no free lunch. You have to pick stocks. This is no longer the kind of 15 years of QE and forward guidance that everyone gets trophies.
We never liked the participation trophies, did we? That was Chris Verrone of Baird Strategas.
No,
it's back to winning, Bremo.
I'm anti-participation trophy. You know? I felt that way with kids too. If you win, you win. If you lose, you lose.
Yes.
Yeah, no, they didn't quit sport again. Yeah.
Right? Oh, they quit sport after that.
You know, win some, lose
Bring
some.
back the participation trophies. Equity futures look like this on the S&P. We're positive by 0.25%, up by 0.6 on the Nasdaq 100. In the bond market, 2s, 10s and 30s heading into payrolls later on this morning. That's 14 minutes away with yields around 420, 10s around 466. Given where we are now, even with the moves yesterday, I think we're still down on the week across the curve, 2s, 10s and 30s, just taking back some of that sell-off we saw at the back end of last week.
Yeah, and it just, again, goes to the point of how complicated this moment is. On one hand, you've got issuance. On another hand, you've got a question about the Fed and all that. And then on the other hand, you've got oil prices and where they exactly are going. And that also is one huge input into inflation and, frankly, the bond yield perspective.
Deal or no deal, the strait's open, kinda?
Yeah, it's great.
That's the last 24 hours, sorta, kinda?
Sort of open.
But maybe not open to US shipping?
Not according to the Iranians.
Right,
and if you're any
what
ship,
kind of deal is that?
And if you're any ship that wants to get through, you have to pay not a toll, a service fee.
It's like being sort of pregnant.
That can't happen.
Well, it's not really.
You have concepts of a plan.
Yeah, concepts of a service fee.
That's a conversation I'm not weighing in on. Okay, Brent crude this morning, 82. WTI is 77.
It means it can't happen.
Okay, just going to avoid. All right, let's get you some morning calls. First up, Goldman raising its price target on Cloudflare, seeing opportunities from a new internet business model. Your second call from Citi, downgrading JetBlue to sell, citing a, quote, deteriorating risk-reward for the shares compared to the major airlines. That share's having some problem. That company, Abramowicz, you've talked about JetBlue a few times.
Well, this is the K-shaped economy, and a real question here about the lower-income consumer, or just even trying to cater to people who are looking for a deal. And that's ultimately you're getting crowded out. Look, when you go to buy a ticket, you see like the basic.
Yeah.
You don't have any leg room. You can't put whatever, but you're still flying the Delta or the Uniteds of the world, and that's competing with the low-cost carriers.
I used to be a Mosaic JetBlue customer, right? Used to be, frequent flyer, vacations,
Mint
that
is
kind of
very
thing.
good.
Mint's a great product.
Yeah, very
I
good.
speak highly of that product. Then after the pandemic, I lost my status, right? And I remember Robin Hayes. This is another status complaint.
Yeah, I was going to say, here we go.
Guy Johnson spoke to Robin. He used to run the company, and Guy said, John's about to lose his status.
Yeah.
Like, he was Mosaic, loves flying with you, blah, blah, blah. And he said he should fly more. And that was the response. And I never flew JetBlue again after that.
Yeah,
I took my
understand
stand. I just never flew JetBlue again after that.
This sounds like a theme.
It is a thing. I'm running out of airlines,
You're
Bram.
right.
Yeah, I was going to say, where do you have status?
We're back to Delta.
Oh, you're
We're
status
back to
at Delta.
Delta.
Okay.
Yeah.
Give you status?
Sort of similar stories going to play out in the next 12 months.
100%. You'll be
Scott
like,
Kirby.
Ed.
United, love them. All right. Let's get to the final call. Deutsche Bank raising its price target on CoreWeave, saying it's very bullish on company fundamentals. The stock is up by 3% in the pre-market. Payrolls just around the corner. Let's get to that with Greg Peters of PGIM. He writes the following: the labour market is somewhere between stabilisation and acceleration. Our base case scenario is one where continued growth momentum supports nominal growth and the Fed hikes rates this year. Greg joins us now for more. Greg, welcome, buddy. It's good to see you. What are you expecting to see in about 10 minutes' time?
Well, I'm not really sure. That's the whole, that's the whole issue on the table here. I think there's an inordinate amount of potential volatility just given where this one payroll prints. And we know that this is a highly revised data series. So we're hanging on this fraught number that's highly revised. And so that's the world that we live in. And I would say we better get used to it.
Greg, how material do you think it would be or wouldn't be to the Fed decision that's coming up in September? Ultimately, for many people in the market, that's how they used to look at this data and have looked at this data for such a long time. Is it different this time? Has that changed already?
Well, I think it's always dangerous to hang your hat on one single data point, but I think this single data point is quite critical here. If, for example, if you see something kind of below 50, I think that does change the mindset in the marketplace, at least around the Fed's willingness to, raise rates. Conversely, if you see something above 100, I think that is added fuel. So it is it's important. And normally I don't get all that excited over a single data print on a Payrolls Friday, but I think this one carries more weight than it ordinarily does.
Greg, what's your reaction to last week's Fed meeting? I mean, do you think that Fed Chair Kevin Warsh is being unfairly criticized? Or do you think that actually the uncertainty being baked into bond markets has been negative or potentially punitive for growth or potentially even just generally the Fed's objective?
Yeah, well, they say timing is everything, right? So it's very difficult to pull guidance away from the marketplace in a highly uncertain time. So if we were in a much more placid environment, then I think it would go more smoothly. But, we are in the midst of, a war in Iran. We're, seeing above target inflation for the past 5 years, as you mentioned. There is a lot of uncertainty around the labor market. And so the market participants are looking for a little guidance, a little roadmap into what the Fed is thinking. And so we're just kind of left to our own devices. So I applaud in many respects what the chair is trying to do. But at the same time, it's really hard to do that at this particular time in the marketplace.
How much control does the Fed have over the long end of the yield curve? And I'm not saying that they're losing control as much as someone else is taking control, which is the central bank of Amazon and the central bank of Alphabet and the central bank of Microsoft, which have been issuing tons of debt at the long end of the yield curve, overwhelming the market and, frankly, affecting the dynamics that much more potentially than inflation expectations or some of these other metrics. I mean, how do you view the Fed's actions versus the broader market backdrop?
Yeah, I think that is the story in the marketplace. Honestly, there is this deluge of back-end duration hitting the market. And I think it's important to remember that we're just starting, right? So we're in, let's just call it the second inning. This hyperscaler debt issuance story has really just begun. So that is a crowding out effect. That's additional pressure on the back end. And so, central banks have very little control over the back end other than this idea or this notion of credibility. So that's where the back end, is responding. You're having a twofold hit where there's a question, and maybe it's not quite credibility, but uncertainty, thus risk premia. And then on the other, you have this hyperscaler issuance that's putting a lot of duration dollars into the marketplace. So once again, I go back to this narrative that timing is everything, and the timing is really quite poor in order to enact this new, less forward guidance world.
Greg, do you think that the Fed needs to hike in order to establish that credibility?
If the data doesn't roll over, so you would have to see payrolls be quite weak today. You'd have to see inflation come in really quite moderate next week in order to kind of see that happen. Other than that, I actually think the great irony here, or the cruel irony, is that getting rid of forward guidance is a way of not painting yourself in the corner, but by doing so, Warsh is actually backed into a corner, right? So I actually think he has to, and the committee has to hike in order to kind of gain that credibility back. And you just can't keep talking about how important it is and not do anything about it. You basically have one shot to do that, and that was the first presser. The second meeting and the second presser, that's why the market reacted as such.
Greg, what would you point to specifically as evidence that this Fed has lost credibility that they need to regain as soon as September?
Yeah, well, you're not seeing it in the normal channels, right? So you're not seeing it in bond market volatility. Those measures are really quite muted. You're not seeing it in break-evens, forward break-evens, so five-year. So you're not really seeing it. It's more of the nominal yields, right? So you've seen a real move in nominals. You could say that a lot of that has to do with the strong underlying growth, but I also think that is kind of capturing some of that risk premium. So there's not clear evidence that there's credibility loss, so let me be clear about that, but there is concern about what the direction is and the uncertainty, and it hasn't permeated and been measured across these normal metrics, but it's happening in the marketplace. So it's one of those things, Jonathan, that it's really difficult to point your finger at one particular item.
Final question. I've only got 15 seconds. My favorite question of the week, and it's Abramowicz. Do you want some 30-year alphabet debt or the 30-year Treasury? Greg, if you had to choose, what would you choose?
30-year Treasury.
Greg Peters of PGIM. It's a different answer to the one we got yesterday, isn't it?
It's a different answer to Priya Misra earlier on JPMorgan. This is really interesting. The idea of, would you rather just take the straight duration or would you like the credit cushion? Depends on who you are.
Tune in for why next month when we have time and Greg is back on the programme on Payrolls Friday. And we'll see how they've traded, right? How the 30-year alphabet piece has traded in the market and how 30-year treasuries have traded.
All right,
okay?
game
it's
on.
a setup.
That's right.
All right, cool.
Next week on Real Yield.
You going to host that?
No,
Scarlett might have something to say about it.
No, absolutely not. I'm sure that that will be addressed.
The Payrolls report is just around the corner. Stephanie Roth of Wolfe Research joins us next. Payrolls just around the corner. The report, the number, 20 seconds away. The scores look like this. Equity futures on the S&P 500 positive by 1/3%, higher by 0.66 on the Nasdaq. The main event, it's been in the bond market for the last few weeks. 2s, 10s and 30s. Yields still elevated, down a single basis point on 10s. 467 on 2s, 423. Yields lower by 2. Let's get to this data. Mike McKee has more. Good morning, Mike.
Good morning, John. Well, it is a disappointment, a kind of a surprise here that may throw some confusion into what's going on with the Fed. Negative 23,000 jobs. There have been people who've been forecasting that might happen sometime soon. Ian Lingen over at BMO turns out to be right today. The unemployment rate, though, drops to 4.1%, and I imagine what we're seeing there is another decline in the labor force. We'll take a look at that in just a second. Change in private payrolls, 30,000, and also the 2-month net revision, 103,000 taken away. So what we're looking at is a labor market that is much weaker, at least on the hiring side. The change in private payrolls, as I mentioned, 30,000. Change in manufacturing, 5,000. Average hourly earnings up only 0.1%, so no inflation pressure there, puts the year-over-year rate at 3.2%. Hours worked at 34.3. That's the same as it was in June. And the underemployment rate, 7.9%. The labor force participation rate does tick down to 61.4% from 61.5. So I'll take a look at the underlying numbers and get back to you in just a second on
Mike, thank you, buddy. You can guess what's happening in financial markets. Let's just start with the headline. There's a lot to figure out here, but for the headline, negative 23,000. The low estimate in our survey was 40. Positive. The median was 80. That's a big downside surprise. So in the bond market, let's start there. 2s, 10s and 30s. You look across the yield curve, you'll notice yields dropping quite aggressively at the front end of the curve as people reduce at least near-term expectations for Fed action, with 2s back down to, let's call it 416. In response to that, equities pick up on the S&P, on the Nasdaq, the Russell, with some outperformance around the small caps off the back of this, up by 0.75%. Lisa, just to work through the data and Mike will get to the details, it's a downside surprise on the headline number. You've got that quirk in the participation rate again. So you've got unemployment falling back from 4.2 to 4.1. We were looking for that to remain steady and unchanged at 4.2%. And then wages coming in softer than expected. Make sense of this puzzle this morning if you can.
No, thanks. I mean,
Right?
I think that the only way that some people will try to explain this, first, I think that there will be a cohort of people who say it's a random number generator because ultimately it says more about the overarching dynamics of the input of available workers versus the demand on one side. To me, the thing that sticks out is 4.1% unemployment rate. That it ticked down to the lowest level going back to June of 2025, and it raises this question: is it just that people are dropping out of the force? Well, it looks like actually the number of underemployed went down, or at least the percentage. So this, to me, looks kind of like the productivity report yesterday, which speaks to a robust market that is not inflationary. Again, this goes to this question of, are we seeing what people are hoping for, which is increased productivity, more disinflation, but a solid economy?
We're in the process of digesting this data. This is the first move. We always say it, not necessarily the right move. A bit into the front end of the curve, a bit into bonds across the curve, but you see the bigger move at the front end, just dropping by 7 basis points on 2s. Equities responding positively to this as well. Mike, there's an obvious question when you look at data like that, whether it's the headline read, what it's happening with unemployment. Am I seeing the consequences of a supply story or a demand story or both, Mike? What do you see in the data?
Well, I hate to say this. I hate to use this word because everybody hates it, but seasonals. There was a decline of 50,000 jobs in local government education in July. Now, usually those people would tend to fall off the payrolls in May or June. And so I think what we're seeing here is a sort of a distortion in the overall numbers. If you add that 50,000 in, it would be a low 20,000 jobs or so created, but much better than what it looks like now. And when you look at the underlying categories, what you're seeing is slower job growth. So you're taking away probably from the demand side. The construction jobs were up 22,000, which you'd expect given the way construction is going these days. But a low hire in manufacturing and a whole loss of jobs, 19,000 in the retail business. And then in terms of leisure and hospitality, 40,000 jobs lost after 43,000 jobs lost in June. And we don't know exactly, but that may have a lot to do with the timing of the World Cup and people who were hired earlier in April and May to work on that. So it's not as bad on the top line as it appears, but it isn't great news either way.
Mike, we'll give you some more time. I'll come back to you in just a moment. We've got Stephanie Roth of Wolfe Research with us around the table, combing through the same data. Stephanie, good morning.
Good morning.
A weak report or a report I can ignore?
I think it tells you that the labor market is softer than it appears earlier in the year. And to Mike's point earlier, like there appears to be some seasonal issues in the data, just generally speaking. The trend is probably a labor market that's a lot cooler than people had previously thought.
The bias would be, what does it mean for September for this Federal Reserve? Difficult to look at this morning, Stephanie, and say the labour market's a source of inflation that we should worry about. How would you characterise things?
I think that's exactly right. I think it tells you that if data looks somewhat softer in the next couple of months, especially when it comes to the inflation side, they're probably not going to want to hike in September. They're probably going to want to just see how the data progresses. Now, that's going to probably have to mean core PCE tracking below 0.25% roughly over the next two prints.
Just want to keep going over the path to September, Lisa. We've got one more jobs report after this. We've got two more CPI reports, one next week before that September meeting. And there is a big Jackson Hole speech which will be attended and given by the Fed chair, Kevin Warsh. There's a lot of work to do between now and then.
And frankly, the labor market has not been the source of inflation throughout this entire period. So how much does this matter? And Stephanie, that's what I would ask you. At a certain point, if you haven't seen the labor market as a source of inflation, but inflation's been persistent, is it sort of the breakdown in the Taylor rule? Is this sort of a breakdown in the relevance of this metric?
I think it's a reminder that there's a lot of supply issues that's driving inflation. It's been a combination of tariffs, you've had the Iran war, and then on top of that, you've had AI adding to inflation. The combination of these things add about 100 basis points to inflation. So if you strip that out or realistically just move through time as those shocks subside, then you're back to inflation that's a lot closer to 2% without the Fed having to act.
What do you make of the fact that the participation rate in the labor market fell to the lowest level since February of 2021, explaining why maybe we saw the unemployment rate come in even with a very disappointing overall headline number?
Yeah, I mean, I think it might be to some extent noise. We also had to be fair, we also had a similar trend in the print before this. I think to some extent we have to kind of smooth through that, and it's an environment where participation is a little bit softer than where it's been, but nothing that is so onerous. My guess is in the next print or so, you'll see a bit of a bounce back. The household survey is very volatile, so I wouldn't be surprised if we saw a big jump in the next print and we're kind of back to a more normal level of participation.
This morning, UBS's Paul Donovan put out how firms do not simply tell the BLS about their payroll numbers. So do you think because this report feels so out of the ordinary, people are going to start to question once again how credible these BLS numbers are?
I think they're definitely going to ask about the credibility of the numbers. I mean, especially since you just continue to get whipsawed around. I don't think it is a real broad-based issue when you extract out and you look at the trends, but clearly there are issues when you look at the month-to-month data, and you have to sort of smooth out kind of what's going on. There were some theories that earlier in the year, immigration was boosting the numbers to some extent in terms of the establishment survey. So it's possible that it was artificially inflated earlier in the year because, people felt more comfortable in this, maybe they got their change in their status and therefore they were able to actually report employment in a legal way. And therefore that's kind of rolling out. Now we're seeing what's left under the surface, which is a labor market that is fine.
If you're just tuning in, welcome to the program. It's fine, but it doesn't look fine when you first had a look at that number. It's negative 23K against an estimate of 80. 80K was the median. The range was pretty wide in our survey, 157 at the high end, 40 at the low. So well below even the lowest estimate in our survey here at Bloomberg. Quirks here, there and everywhere throughout this labour market report this morning. Unemployment dropping back to 4.1%, which is incredibly low. But it doesn't come with the wage pressure you might expect of a move like that in unemployment. Wages actually declining relative to expectations, softer than expected, still positive by 0.1 month over month. We were down from the expected 0.3% and the previous read of 0.3% as well. So that's the labour market data. You push that through this market this morning and you'll see a pretty big move at the front end of the curve, down 8 basis points on Tuesday this morning, back to 416. A move further out along the curve as well, 10's down 6 or 7 basis points to about 460. We've got a CPI read next week, which is still really, really important. And one more payrolls report after this before you get to that meeting in September for this Federal Reserve, and an additional CPI print as well just before on September 11th. Mike McKee's had another read of this. Mike, on the third read, are you in a better place to explain what this is all about this morning?
A little bit. One thing with the unemployment rate is, again, it's a function of the labor force, which fell by 264,000 last month, according to the BLS, compared with a negative 720,000 in June. The employment level was negative 87 in the household survey, but that's much better than the negative 507 that we saw in June. And unemployment in the household survey down 178,000. But it's the drop in the labor force that is really affecting the unemployment rate. So it's not so much that the more people are getting hired and the labor market is tight. It is just that fewer people are looking for jobs. And I'll leave it to others to try to explain that in the short run. Looking at some of the establishment survey jobs, the one that always gains is healthcare and social services. But this time it was only 22,000. We've been in the 30s and 40,000s for months and months, and now we're at 22,000 for that one. And I mentioned the seasonal adjustment factor with local government education being down by 50,000. And then the leisure and hospitality does show signs of maybe part of this being the World Cup effect. Arts, entertainment, and recreation fall by 16,000. Food and drinking services places fell by 26,000. So maybe people hired up for some of the World Cup visitors, and now they don't need them anymore. So there are some things in here that do, as you mentioned, sort of take the edge off it, but it's still not something that's going to push people to raise rates or lower rates one way or the other.
And Mike McKee, well said. Appreciate it. This from Kevin Gordon of Charles Schwab Bramo just moments ago. There is no signal to take from this jobs report. This shifts 100% of the focus to CPI next week.
And a lot of people seem to agree. I've gotten other comments, someone saying this completely conflicts with what they're seeing from their companies as an investor. The labor market seems fine to improving. Some skepticism about the timing, and then someone else said economics, the science of predicting the past. So it seems like a lot of people are looking at this and saying, okay, we're not getting much from this, let's move on. In other words, when you asked me to interpret it and I said no thanks, I think maybe everybody else is too.
I'll tell you who's happiest this morning. Do you know who it is?
Kevin Warsh?
It's their evening. They're in Japan. It's Tokyo.
Yeah, that's for sure.
Dollar yen down at 157. We've got a 0.8% move on that currency pair this morning. Stephanie Roth of Wolfe Research still with us for a final beat on the data and not the jobs data. Let's move on to next week. What are you expecting to see in the CPI print?
Yeah, so we think CPI will come in around 23 basis points, which, based on our sort of mapping to core PCE, which is, of course, what the Fed cares about most, that would be kind of a similar 23 basis point number, which is just below the threshold where we think they'll feel more comfortable staying hold. Given the data that we got today, if our forecast is right on CPI, I think there's a much greater likelihood that they end up staying on hold and just see how all this messiness shakes out. To what extent is the labor market actually showing signs of softening? I think what they'll ultimately find is that the labor market is okay, not as robust as it seemed earlier. It's improved versus last year, but not strong, and certainly not generating inflation. And the inflation backdrop will probably look a lot better. The seasonals are very much in our favor through the back part of the year, where inflation is just very likely to naturally drift lower.
Steph, it's good to see you. What is this? Thank you. Stephanie Roth there of Wolfe Research. We've got a decent understanding of where things are with inflation at the moment. And we've got a decent understanding, I think, after the FT report in the last 24 hours about what it might mean and what it might not mean for the Fed Chair Kevin Warsh. 2 hot prints, and they'll be hiking in September. But that's going to be quite a high bar, given the expectations that Stephanie and others have for the next few CPI prints.
A lot of people seem to think that sequentially and sort of a year-over-year comp, you're going to get lower CPI prints, and that we've already seen the peak in inflation and that they probably won't get that. This seems to add to that, this labor market report. I find it really interesting how many people are just saying disregard, too confusing,
no signal.
It doesn't make any sense. Neil Dutta actually has a different take on it, where he comes out and says, actually, this is indicating some weakness, and this speaks to what Andrew Hollenhorst is saying as well. So again, this is the question that the Fed's asking with respect to the framework. What data do you use? How do you consider this? How do you measure inflation? And right now, this morning, this is evidence the market's grappling with the same thing.
I'm waiting for Citi and Andrew to publish any moment now, because this is kind of what he's been waiting for, right? And he's still looking for cuts
yeah, exactly.
later this year. Let's get you an update on news worldwide with your Bloomberg brief. Fonnie Quinn has more. Hey, Fonnie.
Hey, John. Thank you. So recapping the jobs data then, July non-farm payrolls coming in with a downside surprise, dropping by 23,000 versus estimates for growth of 80,000. Employment declining in education and retail, trending up, though, in healthcare. The unemployment rate ticked lower to 4.1%. The yen jumping against the dollar following that data. The US, Japan's historic currency intervention coming to the surprise of key allies too. The Financial Times reporting policymakers in Europe were blindsided by the arrangement, with the US not informing the ECB it sold euros to buy the yen until after the transaction. The hottest buy of the summer, apparently, is the $10 Dunkin' gift card, thanks to a marketing campaign by Pays. The digital wallet is offering a $10 reimbursement for spending $10 or more at specific retailers. Savvy consumers are taking advantage, with some redeeming hundreds of dollars in credits. And that's your Bloomberg Brief. John.
Fonnie, the important stuff. We appreciate it. Fonnie Quinn, thank you very much. Did you know that?
I spent a disproportionate amount of time trying to scan that story quickly. I still didn't understand how it worked to get free cash. Do I buy a Dunkin' or do I get something else?
Still trying to make sense of this jobs report. We'll do that next with BlackRock's Jeff Rosenberg. As yields fall this morning across the curve, particularly at the front end, on a negative payrolls print.
labor market is softer than it appears earlier in the year. There appears to be some seasonal issues in the data, just generally speaking. The trend is probably a labor market that's a lot cooler than people had previously thought. If data look somewhat softer in the next couple months, especially when it comes to the inflation side, they're probably not going to want to hike in September.
That was Stephanie Roth of Wolfe Research tuning in and joining us just moments ago. If you're just joining us now, this is the data, the reality in the American labour market, according to this report. Negative 23K against an estimate of 80,000 in our survey. That's a big downside surprise on payrolls. Unemployment fell back too. Some quirks in this one, down to 4.1%. The expectation was for that to hold steady at 4.2%, and wages coming in softer than expected at 0.1% month over month against an estimate of 0.3%. And then the emails started to come through. The terminal subscribers started to type away. And they're all saying the same thing. No signal, ignore, focus on something else.
Well, it's just difficult to interpret this because it's sending a lot of conflicting signals. And frankly, there are a lot of bigger questions like what is the employment base and what is the break-even rate of job creation that's necessary for a full employment market. So you can ask all of those bigger picture questions at the same time that you're looking at the headline numbers. That said, there are some people saying actually there is weakness under the hood, or at least it's not as strong as people thought. And you're certainly not seeing the inflationary input. That said, it has never come from the labor market. It's always come from the supply side shock. So again, there are a lot of different crosswinds here, which is the reason why people are saying it's Friday. I want to just go to the beach.
Get to the beach. Might be there already, Bramo.
Yeah, no, right?
I know some of you are. Let's get to the equity market. Yes, we're positive by 0.5 on the S&P 500. I'm jealous. We're up by 1.2 on the Nasdaq. We're buying equities off the back of this. Small caps doing well, up by 1% in the bond market. Here's your bid, the rally, 2s, 10s, 30s. Yields lower at the front end by 8 basis points. We're back to 4.16. Jeff Rosenberg of BlackRock, always with us on Payrolls Friday, joins us now for more. Jeff, welcome. Is this something you can ignore, or is there some information that's worth paying attention to?
Yeah, I think the headline is a bit confusing because you've got the drop in the unemployment rate on a very weak headline and a weak revisions. I'd be hesitant to just write this report off because I think that the revisions in the headline number are pointing to weakness, while the drop in the unemployment rate is really about the supply side and the drop in the participation rate. So I think you can have those two things happening at the same time, and that's how you square the message there. And I wouldn't completely ignore it, and the markets are not completely ignoring it because you're seeing a big hike probability come out with the front end rallying here, and I think that makes a lot of sense.
Yeah, it was more than 50% chance that there was going to be a September rate hike, and now I'm looking at less than a 40% chance currently being baked into Fed funds futures. Jeff, what's your understanding of what the tell is here for inflation? How much does it matter to have inflation coming from wages versus the supply side when it comes to whether the Fed will hike and how they view the state of the economy?
Yeah, well, you know, it's both. And we've had a serial set of supply side shocks since COVID. And that's really been what's been holding up inflation. But the labor market is relevant as well. And so the wages picture here is a little bit positive. I think that's contributed. Let me be more clear here. So you had a little bit disappointment in terms of the wage figure in the payroll report today. That features into longer run services inflation. And that's helpful with regards to the expectation on the inflation front. And as you know, you were talking about in the earlier segment with Stephanie, you know, it's really the inflation reports and the inflation picture that's in the driver's seat for the FOMC. But the read through from the payroll report from the wages is helpful with regards to seeing some easing there. And I think that's the kind of takeaway into next week.
How difficult is it to really understand these metrics from any historical point of view? And I ask this because a number of investors who've come on the show who are overseeing portfolio companies say that they see robust hiring. We were talking about Neil Richardson seeing 7% wage growth for people who switch jobs. You saw the quits rate come in. You see these other metrics under the hood that point to quite a bit of resilience and even rejuvenation in pockets of the labor market. How do you square that with sort of the weakness that this implies?
Yeah, it's a little bit hard to square those two things. I think, you know, when you highlight job switchers, it's important to kind of distinguish that there's always a premium for the job switcher. The job switcher labor wage inflation rate isn't the broad economy wage inflation rate. So those two things will always be a little bit of a measurement difference. And when you're looking at specific companies, remember that this payroll report is very broad in terms of its capturing across the economy, individual sectors and companies. Those anecdotes can always be somewhat different from what you're seeing in the broad-based data like we're seeing today. So you can have those differences. I think the overall trend and what we had seen had been a little bit stronger, more of a stabilized labor market. The report today kind of points to some slowing. So, 1 point doesn't make a trend, but it is something to pay attention to, particularly, on the revisions. It's a noisy data set, so we don't want to overstate that, but I wouldn't completely toss it out of hand.
Hey, Jeff, you're right, and I think that's the point of debate that we've got to have going into the weekend. You were right to point out the market's not ignoring it, but let's think about what the market's doing right now. Twos are rallying because we're taking out the prospect, the potential, or at least reducing the likelihood for an interest rate hike from this Federal Reserve. But at the same time, equities are rallying because there is a belief also there's nothing really concerning in this labour market. That's where there's space for debate, I think, Jeff, this morning. Are we seeing some slowing momentum that might be on the margin concern for you, for others? And we should have that debate into the weekend, I think.
Yeah, and I think we'll have that debate. The payroll report always sort of sets the monthly tone in terms of the growth side of the economy. What's happened in the post-COVID environment for markets, and particularly for bond markets, is just the growth side of the picture has taken a second footing to the inflation side, particularly because of the Fed and, you mentioned the FT reporting and potentially what we would expect to see from Fed Chair Kevin Warsh in terms of the inflation piece. So I think that becomes more relevant. And this report, we'll debate it over the weekend, but it'll quickly become yesterday's news. And the more focus will turn to the inflation side, as has been the case really for the last 5 years, as we've been in this above inflationary target environment.
CPI next week. Jeff, looking forward to it. Thank you, buddy. Jeff Rosenberg there of BlackRock. At the moment, and this is early days, things can change throughout the session, but at the moment, the market sees the best of both worlds. Reducing the likelihood of an interest rate hike in September off the back of this, but not much signal, nothing to really worry about based on the feedback we're getting so far. That's where there's a bit more space for debate.
Yeah, especially when we get the CPI reprints next week, because potentially we will get that upside surprise, although a lot of people are saying that's not likely. I will say it does seem like things are kind of going the Fed's way to remain on hold, and that's what the market's pricing in.
And the administration, lower unemployment rate, construction 22K, manufacturing 5K. That is a good story to tell.
Should we shut it down?
Shut it down.
Shut it down. Let's
Happy
get to the
Friday.
weekend. There we go.
Friday.
There you go. Nah. Still, nah.
How to get it in?
I don't like that phrase, you know?
I know.
Anyway.